Good morning, everybody. Can everybody hear me in the back? We're good? Perfect. We are missing some people, so we're probably going to see some traffic, weather, all the things. So we might have some people trickle in the middle of our training this morning. So thank you all for joining us this morning. Again, we've got our TV Land virtual that are joining us, so hopefully they can also hear what is happening. Today, we are here to talk about advanced compliance training. If you are joining us virtually, if you're having technical difficulties, you can call the number or put it in the chat box once the training has started. If you have compliance questions on the virtual, you will also use the Q&A box. Here in the room, you'll just raise your hand. If you, after the training, once the training has ended, either today or yesterday, you can email rental trainings at nchfa.com and we will happily assist you. Be sure to access the training using the name and email that you were registered with in order to receive credit. Again, these are people who are virtual. And closed captioning is available if you need it virtually. In the room, we need to make sure that we are respectful of those around you. Please make sure that your phones are silenced. And in order to receive credit for the training, computer devices may not be used during the training. Please limit use to breaks and lunch. Obviously, there are emergencies. We just don't want you working the entire training. And we will take a break around 10:30. And then we will take lunch at noon, and then we'll have another afternoon break. There are restrooms right out this door, and if you go out the back door, there are restrooms to the left. Next week, by Friday, you will get your survey for class, and this is both virtual and in person. You have to complete the survey in order to get your certificate. So make sure that you complete that survey. Check your junk, your spam, your deleted folder if you don't get the survey. And then if you have checked all of those things and you still don't have your survey by the end of next week, you can reach out to Gianna. So we're going to talk about some important updates. Some of these may be a refresher from yesterday. Those of you that weren't joining us yesterday, it will be new for you. But a disclaimer that the information contained in the presentation was prepared and related handouts are accurate at the time of the presentation. For the release of guidance from the IRS or from HUD or from the agency, additional updates to our policies may be necessary and will be communicated by the agency. One of the things that is new this year are the rental trainings at nchfa.com email address. In years past, everything went to compliance help, whether it was RCRS related or whether it was related to trainings. And now we have separated those. So for rental trainings, that is where you're going to email questions during training or general compliance related questions. Compliance help, you should use that strictly for RCRS issues and questions. If you accidentally email the wrong one, we will fix it. It just might take a little bit longer. So try to email the correct email for whatever issues you might be having. A big update for anything effective October 1st of 2025, we have new fees. The utility allowance fee was $150 and now it is $250. Ownership change fees without a agency loan, those went from $250 to $500. If there is an agency loan, that fee went from $500 to $1,500. If there is a partnership change fee or a management company change fee or a loan modification, There was not a fee associated with those, but there is now. What is also very important to remember is if you are doing multiple of these, there are multiple fees. So it's not a one fee over the other. So if you are changing ownership and changing management and modifying the loan, you're going to pay $2,500. Again, 3 of these things did not have fees in the past, and they do now. So when you when you send in your paperwork to do any of those, if we do not receive the check, and it has to be a paper check, hopefully in 2026, we will be able to take online payments. But for now, it is a paper check. Make sure that the property name and the reason is listed somewhere on the check or documents attached to the check, the memo line, something, so that we know what property it goes to and what you are paying for. But we cannot process the requests or the change forms until the fee has been paid. Report cards, obviously these went out at the beginning of the year and we are getting ready to send them out again. And it is imperative that if you would like to remain on the approved management company list or get on the approved management company list, that you know what is on the report card. And because January is when they will go out, we will get all of our information together in December to see how the year ends. And then those will go out to management companies in January. Some of the things that are on the report card, or to be on, this isn't on the report card as much as it is that you have to be an approved management company. You have to have at least one other project in your portfolio that is similar. So if you're wanting a IRS compliance, you have to have another property in your portfolio that is in the IRS compliance period. It doesn't necessarily have to be in North Carolina. You just have to have one. Part of the reason that we want to make sure that you are up to date with all of the regulations. If your portfolio is nothing but extended use properties, you might not be as up to what is required for the IRS standards. So that's one of the reasons we want to make sure you have something similar in your portfolio. You have to be registered with the Secretary of State. You have to be a registered business. You have to request key assistance timely and accurately. We review those on a quarterly basis. You need to be putting your vacancies in the VNR. You have 8 calendar days to be considered timely. They do periodic sampling to make sure that that is taken care of. If you have questions about any of the key or vacancy and referral items for the report card, you would reach out to Louise Gardner. You need to be reporting into RCRS timely. We allow an 85%, so it gives you a 15% grace on being late. We know that things happen. We realize that there might be people who are, you might be short-staffed. It might take you a little bit longer. You might have had a really heavy month and you just had entirely too many properties and too many events to enter. That is why we allow that grace period or that grace percentage. It is your responsibility to track this. You do not get quarterly updates. However, you now have the ability to track this any day in RCRS. So if that's something that you feel like you need to do, that you don't have access to, you need to reach out to your management company, whoever the admin is, to make sure that you have the appropriate roles in order to view that information. And if you have questions about how it works as you're getting in there, just let us know and we're happy to assist. It is a new report, so we realize that there might be some wonky things that will get ironed out in the future. But it is your responsibility to track. So I would make sure that you are tracking and you are looking at least once a month to make sure you're on board. Because if you drop below that 85% early in the year, you have a chance to catch up. But if you drop below that 85% in December, you might not have enough events to get yourself over the 85%. So you've got to make sure that you're taking that initiative and checking early in the year and regularly. Training is part of the report card. At least one staff person in a supervisory capacity has to, who has to attend at least the 3 agency sponsored trainings, which is the Compliance 101, which was yesterday, Advanced Compliance today, and then the DHHS targeting training. In August, September time, there are emails sent out to management companies that are not meeting that requirement, so that you have a chance to catch one of our last trainings. And you can do those virtually or in person. There is not a requirement to be here in person as long as somebody from a supervisory capacity is taking all of those trainings. And if you have questions about the training part of the report card, you would reach out to Stephen. At least one person, staff person in a supervisory capacity has to be certified with one tax credit compliance designation. And all of those that are acceptable are listed in the Appendix C of the current QAP. If for some reason there is a management company that is on the list and has been on the list and there isn't somebody with that designation, they are grandfathered. But if you are ever to be removed to get back on, you would have that grandfathering goes away. Again, we presume that those things haven't changed. So if you have proven that you have gotten it, but we may do a random sampling just to make sure that those certifications are still current. A big item, and this is completely controllable by management, is you cannot have any uncorrected non-compliance at the end of the year beyond the cure period. If you got the final report at the end of December and you still have, or the compliance results letter late in the year and you had to ask for an extension, those will not be held against you because you're still in that cure period. But once the final report has been issued, if you have uncorrected non-compliance, you are subject to be removed from the approved management list. In order to not get removed, you need to make sure that all uncorrected non-compliance is fixed. And in order to do that, you need to submit the compliance resolution packets. That is something that we do not track. That is 100% on management to make sure you know what is uncorrected and to fix it. Implementing a rent increase on an existing property without agency approval if we require approval on rent increases. There is no correction for this. If you implement a rent increase without approval, you are removed from the approved management company list for a minimum of a year. Obviously, if you do it again, you're going to be removed again, but there is no correction to this. You get kicked off for a year, and your developers are not going to be happy if they cannot select you as a management company because you didn't follow the loan requirements of your property. So if you don't know that your property needs approval, you can email Krista. She will happily tell you if you require rent increase approval. We will catch them on file reviews. We catch them all the time. In 2024, so prior to 2024, the only properties that needed rent increase approval were properties with an agency loan. In 2025, not counting the state tax credit loans or the workforce housing loan program, they're essentially the same thing. Those loans did not require agency approval until 2024. Allocations of those loans in 2024 require agency approval. In 2025, any allocation of anything, straight tax credit properties included, you will have to get approval. We're not there yet. We just allocated this year. Anything allocated in August of this year, well, any of the 4% or 9% deals, any property allocated 2025 or later, you will have to get approval. Those are not placed in service yet. We don't have to worry about that, but it is something to know for future so that you don't get wrapped up in the rent increase issues. Again, they can't be corrected. Reach out to Krista if you have any questions. We'll talk about the rent increases in detail later in the training today. Interim progress reminders. We follow up with us if you have late submissions due to evictions, your residents are not cooperating with recertifications, change in management company issues. We realize that when you change management and you are taking over a property, that there might be some things that need to be corrected, or the previous management company did not do what they were supposed to be doing. And so you're behind the game, and we do allow grace for that. But we have to talk about it. You can't just assume. We need to have a conversation. Ask questions. Don't wait till the end of the year. Talk with us throughout the year so that we can get ahead of the issues versus playing catch up. The report card and any of the progress reminders are only going to go to the operations contact for the management company. So whoever is in our CRS as the operations contact will get the report cards. Only management companies on the approved management company list get a copy of the report card. So not everybody gets it. The owners don't get it unless you are owner managed, then you're both. But owners don't get a copy, only the one contact. So if you've got multiple people, then you need to make sure that the person who gets them knows who to distribute them to. We have a question? Yes, ma'am. So in our CRS, the report that's in our CRS is not the entire report card. It's just the reporting piece. And I apologize because I've not looked at the report in quite some time, so I don't remember what the categories are. So they're individual. And so whatever your 60 is, will knock you off. So the key payments are in there. The vacancy and referral is in there. So any of those where Louise used to send out quarterly reports, she won't anymore because you now have an opportunity. So it'll be the vacancy and referral. And I'm sorry, TV Land asked, I forgot to repeat the question, but the question was on the reports that are in our CRS, if they got 100% on 3 of the 4 and a 60 on the 4th, would that knock them off? And the answer is yes. Because each category is separate. Susan's going to come and speak.
So I think the report that everybody's concerned about is the uploading of documents, because that's the one that is still problematic. And I did want to reassure everybody that we are still working on that report. It will not be held against you for 2025. So that one, you can take that one out. But the reports, the document one. The other reports are good and they are working as intended and providing accurate information. That of the uploading of the tenant file documents, that percentage, we're still finding some issues. For example, if you have a mixed income property that has market units, the report is seeing that you have reported a market unit and there are no documents, so it's counting that one against you. So we're still refining that report. So until it has accurate information, that one won't be held against you. We appreciate those of you who have helped us figure out what the issues are with that report. Several of you have reached out to us, and we appreciate, when you provide us feedback so that we can fix anything that's incorrect. But yeah, we're still refining that report and we'll get there. But for this year, we understand We've heard from a lot of you, you're uploading your documents timely, and we don't want to knock you for that, especially if the report itself is incorrect. So,
But again, that is only the documents report, not the other three. So 3 of the 4 are working as intended, and you will be held to those. Those are not grace period. The only one that is a grace is the one referring to the documents upload. All right. Now that we're done talking about report cards. Next update is this year in our CRS, we added a new certification type, and that is an initial certification. The most common use of that is going to be a resyndication or a new allocation. When an existing tax credit property gets a new allocation of credits, management is asked to qualify the existing tenants by performing a full recertification. That full recertification should be considered an initial certification because it's the new baseline for the new allocation. The system didn't used to allow initial certifications, so you had to do a move out and a move in, which isn't necessarily truthful since the tenant has lived there the entire time. So on a resyndication, that full certification that you do, you're going to count those as an initial certification. Yes, TV Land has a question.
Is there a grace period for lease up properties for the uploading the documents?
90 days. So the question, TV Land, if there's a grace period of uploading documents into our CRS for lease ups, that is 90 days that we allow you versus the 30 for everybody else, which I think we talk about again later. But yes, ma'am. So the question is, this is a HUD property that just got a new tax credit allocation, and asking if there is still a grace period, and there is, because it's still considered a lease up. You still have to wait for construction to be done in order to do, and you generally are still doing that mass move in, trying to get the property redone. And sometimes they're building by building, and sometimes it's one building, but you will still on that get a 90-day because it's still considered a lease up, even though it's not a brand new construction. Yep. Yes. After the placed in service date, you get 90 days. Yep. Yes, Krista.
We are uploading documents to make the 30-day time frame, but in a lot of instances, the documents are returned because they had errors that must be corrected. Would we prefer that they wait to upload the completed file with no corrections and not be within 30 days if the certification is processed late, or upload the files as it is just so that's on time?
You need to make sure that the documents that are uploaded are correct. And you need to probably reach out to your management company for the process that they would like you to follow in making sure that the approved documents are uploaded. Back to initial certifications. Another time that you would use that initial certification is when all of the original household members move out, leaving only members who were added after initial move-in. If we remember, in tax credit world, the household is qualified at move-in. And if you don't have any of the remaining household members, you have to requalify the household, or everybody has to move out if they don't qualify. And so this initial certification, our example here is Casey the mascot moves into Fairgrounds Apartments in 2022. And he's the only household member. A little over a year later, his friend, Mrs. Wolf, moves in with him, which is great. It doesn't matter how much she makes, she's allowed to move in. In another year and a half later, Casey decides to move out, but Miss Wolf wants to stay there. In this instance, because we did not qualify Miss Wolf to live there, you've got to do an interim or an initial certification effective January 15th when Casey moves out to show that Miss Wolf qualifies. If she's not eligible as the new household as of January 15th, she is required to vacate with Casey. She's not protected since she wasn't part of the original certification. Now, if she qualifies, you would do the interim certification and all is right in the world and you just move on. But if she does not income qualify, as of the date that that original household member moves out, she also has to move out. And I will say it also doesn't matter what happened between September and January. She has to qualify January 15th when you do that initial certification. Any questions? So we're going to talk about documents. So our documents, the LORA or the Declaration of Land Use Restrictive Covenants and the Extended Use Agreement, this is what's going to tell you the set-asides of your properties, what your rent limits are, and what your income restrictions are. And you're going to hear the words affordable to and occupied by regularly. Affordable to has to do with income. Occupied has to do with the actual unit itself, which is going to be your rent restrictions. So in your LURAs, you will see multiple elections depending on the funding of your property. When you've got tax credits, you're either going to be the 40% at 60 or you're going to be the 20% at 50. That's your standard. It might also say that you have elected 100% at 60. And then if you have any RPP loans through the agency, it will also list the RPP loans. And then if there are any QAP set-asides that were required for the year that you got allocation, it will also be listed in the LORA. So in this instance, you've got your minimum set aside, which is your tax credits. This one says that 40% must be at 60, but it says both rent restricted and occupied, which means you know that both the rent and the income limits are subject to that 60% AMI. And then also in the QAP, this year that this property got allocated, we required that at least 25% of your units were both affordable to and occupied by, which is rent and income, to households at the 30% AMI. So this particular property doesn't have an agency loan. They just have the tax credits and then the QAP set aside. So they've got at least 40% of their property at 60% and at least 25% of their property at the 30%. Do the 30% units also qualify the 60% units? Yes. So anything under your max will qualify your max, but the opposite is not true. Obviously, your 60% units will not. So if you've got a 100-unit property, at this example, at least 40 of your units have to be under the 60. 25 of those 40 have to be at 30. Now, you could have 25 at 30 and 40 at 60, or you could have 25 at 30 of those 40 at 60. There is a question in TV land.
Two sisters originally qualified to move in, and 2 years later, one sister passes away, and her daughter, who has a job, wants to move in. Do we need to certify for both?
So you have two household members that moved in together on the same day. One of them passes away, leaves one person living there. The household is still the original household. You don't have to do anything funky. That individual decides to move in her daughter and her granddaughter, and that is a-okay because the original household member is still there. So the only thing you're doing is adding them to the lease, adding them to a certification, to the annual certification, and moving on with your life. If that grandma moves out, then you would have to do the initial certification on the daughter and the granddaughter. Did we have another question? You good? Perfect. So until all of the original household members move out, you don't have to, it doesn't trigger the initial certification. If there is one member of the household that is the original member, you are free to continue business and you don't have to trigger that initial certification. So when we're talking about agency loans, we talked about the LURA, how that determines some of the set-asides of your property. So do the agency loans. With an agency loan, you're going to get a commitment letter. This is the description of the property. It is the original requirements at the time of the owner's application. You will then get a loan agreement. Again, description of the property. In your loan agreement, you're going to get your requirements for your reserve accounts, how much is supposed to be in them, how much you're supposed to paying, when to start paying into those replacement reserves. If it's got an ISHP loan, it tells you what kind of reserves you have to have for those accounts. Your rent-up reserves, if you are required to have those. The loan agreement also talks about the financial audit requirements and the insurance requirements for the property. And then you get your deed restrictions, and you will get deed restrictions for every RPP loan that there is. You do not get the deed restrictions, and then you've got the deed of trust. The deed restrictions are going to tell you what your set-asides are and what your your initial rents are for your RPP loans. And how, like if it's a home loan, it tells you how many units are home units and what set-asides are for those. Again, there's the description of the property, and it also, the deed restrictions will tell you how long the affordability period is. Your compliance monitoring requirements in your deed restrictions, it will also tell you that you are required to get rent increase approval. It tells you the set-asides, your initially approved rents, and other fair housing and program requirements. So, underwriting versus construction. We've got program requirements and design specs. Everything works together in a cohesive plan to make a solid foundation for the community. So we're going to talk about Fair Village Apartments. So Fair Village, we've got our LURA, and we know 40% of the units are at 60% AMI. On this one, we can see that there's an RPP loan that says 40% of the units have to be less than 50% of the area median income. And we have all the things at this property, y'all. We have our state housing credits. So this is your, if it's an older one, you'll see the STC, which is the state tax credits. The newer ones, you'll see the WHLP, which is the Workforce Housing Loan Program, where 25% of the units have to be at 30%. And then you have an additional QAP requirement where 25% of the units have to be at 30%. So we're going to back up for a second. Our tax credits at 60%, we know that they have to be rent and income. Our RPP, what does it say? It says occupied by. So that is just rent restricted, not income restricted. Our housing credits, our state credits are affordable too, which again are rent restricted. And our QAP allocation is both rent and income restricted. And we also noticed that the state housing credit and the QAP are both 25% of the units at 30% AMI. So do you have to have two different 25% buckets, or do they both qualify as the same? They both qualify as the same. It's the same bucket of 25% units will qualify both AMIs. You do not have to have now 50% at 30. So we've got 60% rent. That's our highest AMI that we're restricted to. And we've got our 60% AMI for our income restriction. And we know that our 50% units and our 30% units both, I went too fast, both fit inside those buckets. So all of your 30% units will qualify your 50% units and your 60% units. So if we're going back to that same 100 unit complex, generally speaking, most, I would say 75% or more of the properties are 100% affordable. And you're going to have 100 units at 60%. But if you didn't, and you were market rate, and you only had 40 of your units at 60, you could then take 25 of those 40 and make them 50 or 30. And those 25% units would qualify. They fit, everything fits. So all of your 50s and all of your 30s qualify your 60s. It doesn't give you much rent, so you don't want to necessarily do that, but you can. Any questions at this point in the presentation? Perfect. I'm going to pass it along to Krista, and she is going to tell you about the loan requirements.
Good morning. So who needs a rent increase approval? All properties with active agency loans are required to gain prior approval for all proposed rent increases. And remember, as Randa has said for 2 days, that in 2024, there was another category added in 2025 for any allocations, no matter whether it's just federal housing tax credits or whether it is an RPP loan, everybody is going to be required to ask for a rent increase. And that's just the allocation date. If the agency loan has been paid off early, the agency still requires approval of rent increases until the affordability period has ended. Initial rent structures must be entered into RCRS before any rent increases can be submitted for review. Management enters the final rents from the development stage into RCRS as the initial rent structure once the permanent financing has been completed. The state tax credits allocated in 2024 and going forward require North Carolina Housing Finance Agency approval. And then 2025 allocations and going forward is going to require approval. If the loan is paid off early, are we still required to get approval for a replacement reserve request? No, you are not. You're welcome. So the ISHP program is required TCAP loans, RPP loans, which are home housing tax credits in National Housing Trust funds, the PLP loans, SHP loans, and state tax credits for 2024 allocations and going forward. And then in 2025, it'll be for anybody. Always refer to the property-specific loan documents if clarification is needed. And again, you can always reach out to me as well, and I can look it up. So rent increases before the 8609s are issued. All tax credit deals must have agency approval until the 8609s have been issued. When do we discover this has not been done? When the development staff is reviewing the final cost certification. So if you are in the development stage, 8609s have not been issued yet, the loan has not been finalized yet, please reach out to our development staff. Regardless of the funding type, agency approval is going to be required in the 2025 QAP. I cannot say that enough because people have not been used to having to ask for that. So it's going to be easily forgotten. So please, please, please remember that. So in 2026, for all rent increases that have that are going to be requested, our policy has changed. Whereas it used to be you had to enter it 30 days ahead, now it must be entered 60 days. If you have a property, if you ask for more than $50 or $75, depending on if it is a family property or a elderly property, $50 can be passed along if it's an elderly property and 75 if it's a family. But your DCR cannot exceed 1.15 or $1,000 a unit. So it used to be $750 a unit. We have increased that. If you have already requested a rent increase and you have requested it for December 1st, but now because of the changes that we have made, you'd like to hold off, please reach out to me and I will cancel that and send it back to you. Rent increases of $25 or less, you do not need to give us any justification needed, regardless of your DCR or cash flow. Rent increases of more than $25 and the property exceeds a DCR of 1.15 or a cash flow of $1,000 starting in January. With the proposed budget, additional justification is going to be needed. If the proposed budget is significantly different than previous year's audited financials, justification will be needed. I will go back and I will compare everything so that when what you're asking for to make sure that it makes sense. Increases of more than $50 for an elderly property, no more than $50 can be passed along to place unassisted tenants per year with or without justification. Yes, ma'am. That is going to be the, what she's asked is whether that goes with the project-based vouchers or the vouchers you get from like the housing authority. Like your housing authority. No, you can increase that, but you have to reach out to your housing authority to make sure that you give them the notice. I know a lot of those counties require like a 60-day notice in order to get your increase. The question is there any leeway on this if they're not cash flowing in regards to insurance and taxes and such like that? We will look at everything and look at that cash flow. And if it's over $1,000, we will generally deny it. However, if you reach out to me, shoot me your justification as to what it is increasing to, we can look at it. But you have already uploaded, like, for example, right now, all of your 2024 budgets have been uploaded. And then when you upload your rent increase, you are uploading your proposed. I am comparing those two together. And some things, we know because we see it on everybody's rent increase. We know that insurance is increasing. We know that the benefits are increasing. We know a lot of that, but we look and see if something just doesn't make sense, and then we'll reach back out to you. And so with our new proposed, or with our new policy, this is going to be, instead of $50, it's $75 for a family property. So it's $50 for in-place tenants, for elderly, and $75 for families. And even if the rent increase is $25 or less, if your property is required to request an increase, the increase must be submitted in RCRS for approval prior to you making that, putting it into effect. The proposed budget is compared to the actual expenses documented in the most recent audited financial. Fees are being paid to the investor are not allowed. And for example, asset management fees, syndicator service fees, even though this is a cost of doing business. If the line items are significantly different in proposed budget versus actual, we may ask for further justification. The standard vacancy rate of 7% regardless of the actual vacancy rate. Cash flow requirements are, after adjustments are made, 1.15 debt coverage ratio. If the debt coverage ratio is more than 1.15, then look at the projected cash flow. When cash flow is less than, and I'm going to skip right to the January 1, 2026 policy, is $1,000 per unit, we may approve the increase. If it is more than $1,000 a unit, we will either decrease or deny the increase. Implementing rent increases without agency approval will result in the management ownership not in good standing with the agency and non-compliance for the project. Will show up on the management company report card. So make sure that you are going back and looking at your RCRS. Make sure, am I supposed to be requesting a rent increase? Did I request a rent increase and that I did not get approval for? If rents approved by HUD or RD approval and the agency approval required, then what we need to do is you need to send me their approval and I will upload it, and then I can go in and approve your rent increase. Ensure the rents and UAs match those on the approval letter. Ensure the effective date matches the approval letter. And you're going to forward the letter to me. It says Randa, but we've kind of changed hands a little bit. Winning rent increase requests don't include the utility allowance has not been updated. The new policy is that it has to be current on the day that you request that you submit the approval, the request for. Effective date, not a minimum of 60 days. So that's also changed. And asking for a large increase not justified by the budget and or audited financials. And asking for more than one increase in a 12-month period. So you can only request one increase every 12 months. And the UA used in rent increase is not the most recently approved UA. If you need additional help, please reach out to me. That's my direct phone number and my email address. Reserve requests, I also monitor those. So if you have any questions, you can always reach out to me for your reserve requests. There are two types of reserve accounts required: replacement reserves and operating reserves. All properties with an active agency loan are required to gain prior approval before withdrawing funds from the reserve accounts. The required deposits for both account types will be found in the loan documents for the property. All requests to withdraw funds are submitted via RCRS. If the reserve accounts are underfunded, we may deny future requests until the accounts are fully funded. Failure to get approval before withdrawals, withdrawn monies from either reserve account without agency approval may result in management ownership not in good standing with the agency and noncompliance of the project. Yes, ma'am. The question is, if she has a operating reserves account that gains interest, does she have to get approval to move that interest from the operating reserves over to the actual operating account? No, you do not. Yes, ma'am.
Just to add to the operating reserves, if you do not need our approval to take out what is over the minimum required. So if you're required to have $100,000 in there and you have $105,000 in there because of interest or because you just put extra money in there, you don't need our approval to take that $5,000 out. We may ask, like when we look at your audited financials at the end of the year, we may ask, what was that for? Just be prepared to answer if we don't see a reason, but generally we notice what the minimum required is. So if you take out anything above that minimum, you do not need to seek our approval.
When entering or when submitting your reserve requests, please, just like you would when you respond to us for your compliance results letters, look at what you've scanned. Make sure that they are legible, the invoices are legible. Make sure that you're not requesting something that is over 12 months old, because anything like that can get it denied. The rent-up reserves are used for initial operating costs during the lease-up. Withdrawals do not need agency approval. When loan converts, excess funds must be transferred to the replacement reserves. They are used for capital improvements and replacement items, not repairs. Monthly deposits are made. If requesting for reimbursement of expenses, management must provide actual invoices. If requesting for prior approval, management must provide 2 to 3 comparable bids. Including in the request, you're going to give me the most recent bank statement. Make sure you look at that bank statement and that it is for the correct account. The trial balance and your invoices or bids. Typically, the agency requires $250 per unit per year for new construction and $350 per unit per year for rehabs, with deposits escalating by 4% per year. This is not enough to fund long-term needs of the property. Routine replacement items such as carpet, flooring may be submitted quarterly or annually. Minimum balance required in the replacement reserve accounts equals 24 months of the required deposits. If the balance is less than the required amount, withdrawals will not be allowed, even if the item requested is eligible. And exceptions may be made on a case-by-case basis for properties in extreme adverse financial situation. There was something I wanted to tell y'all that was important and I lost it. So just make sure that when you are submitting your reserve requests, if you have more than 4, 5, 6, 7 invoices, a cover sheet, although it might not be necessary or required, it's very, very helpful. If you are taking one invoice and you're not using all of it to be refunded to you, if you have a spreadsheet, I can see exactly how much money you're requesting from that one invoice. Make sure that the unit numbers are placed on the invoice if you are not using a spreadsheet that includes them. Anything that you do to make it more easier for me to audit it is going to speed up the process and you're going to get your approval quicker. Replacement reserve items that are typically not approved are interior painting, blinds, appliance repairs, replacement of component parts such as fan motors or air conditioner compressors, bed bugs or other pest control treatments, landscaping material or services, pressure washing, items that should be covered by insurance. The operating reserve request is funded prior to the loan closing, used for operating deficits during times of economic hardship such as high vacancies. Withdrawals required our approval. An account must be restored to required balance prior to any distributions or payments to owners or investors. To request a withdrawal from the operating reserve account, submit a letter, explain the request along with the most recent reserve bank statement, the most recent trial balance, and proof or detailed explanation of the operating deficit. Failure to submit requests taking money from the reserve accounts without our agency approval or submitting after monies have been withdrawn, our failure to submit more than one request, attempting to submit or open more than one request at a time. So you cannot submit a request today and then try to submit another one tomorrow. Until I process that first one, you can't submit the second one. Request and reimbursement for non-eligible items. There's no summary page for large requests showing the breakdown of the requests submitted. The attachments included are incorrect, wrong property, documents not legible, etc. Some people have uploaded the wrong bank statements for either the wrong property or the wrong account. Just double check everything that you're sending. It makes everything go a lot smoother and faster. And our rent increase policy and our reserve policy can be found on our agency website. Again, if you need any help with any of the reserves, please reach out to me. Audited financial reminders. They are required to be submitted through RCRS annually for projects with agency funding. The audited financials for your year ending December 31st are always due on by May 1st. For any other year ending, they are due 120 days after that date. Failure to submit audited financials may result in management ownership not being in good standing with the agency and non-compliance for the project. So you'll upload your PDF version of the audited financials into RCRS. Should have comparative year schedules. If consolidated, must contain property-specific schedules. Enter the data from audited financial into RCRS. All available information must be entered. Findings noted by the auditor must be addressed with a letter, memo, date, noting all actions taken to correct. And then our instructions can be found on our agency website. When completing the data entry using numbers from some other source that does not match the audit, or not including asset management fees, investor fees in the data entry because they haven't been paid out, any fees listed on the audit that are charged to that year must be included even if the fee is accrued. Or submitting the balance sheets and other printouts in place of the audit. Submitting the audit but not completing the data entry. Late submissions. And if you need any help with audited financials, please reach out to Randa. Your insurance requirements. The borrower shall keep or cause to be kept in full force and effect the following types of insurance coverage: your commercial property hazard insurance, commercial general liability, workers' comp, flood insurance if it's applicable, and fidelity coverage. The borrower, such other and further insurance may be required from time to time by lender in order to comply with regular requirements and practices of lender in similar transactions. Each policy of insurance shall be issued by one or more insurance companies, each of which must have an AM Best Company or Demotech for nonprofits, financial and performance rating of an A- or better. All policies shall list the lender's name and address exactly as it states. No longer standard practice for insurance company to include the loss payee or additional insured on the insurance proceeds checks. We expect to get notified of claims. And there is a new policy, and we have a new email to report all insurance claims by email. Randa. So this email address, the insurance claims at northcarolinahousingfinance.com, is that where they will also notify us of down units regardless whether they're going to claim insurance or not? So yes. So even if you do not plan to claim insurance, if you have a down unit, make sure that you are notifying us and you'll use this same email address. Yes. So the question is, if she has a PBRA with tax credits with the housing authority, does she also need to notify us of down units? The answer is yes. Any down units we need to be notified of. And insurance claims, yes. Promptly pay or cause to be paid all insurance premiums when due on all insurance policies and not less than 15 days prior to the expiration dates of such policies. Provide to lender evidence satisfactory to lender reflecting that all required insurance is current and in force. During the term of the loan, the agency may require modifications to existing insurance or require additional insurance at its reasonable discretion. I apologize. And that again, you can find on our website, all of the instructions. Yes. For an insurance claim where an HOA took care of it. So the question is, do you have to notify us if the HOA took care of the insurance claim with their insurance? So no, you would not have to do that. So the RPP program, the document approval, the lease approval is required prior to loan closing. Upload the lease along with the appropriate lease addendums in RCRS to match the funding sources applicable to property, the tax credit lease addendum, the home lease addendum, all units as they must float. So if you have a property that has 6 home units, everybody on that property should be signing the home addendum. The National Housing Trust Funds lease addendum, again, all units because they must float. The North Carolina Housing Finance Agency will not verify, review the actual lease going forward since the addendums are required and covers agency requirements. We still encourage you to have your lease reviewed by an attorney. And if you have any questions, you can reach out to Stephen. The TSP required prior to the loan closing. You're going to upload that via RCRS, including your checklist. Refer to the agency website for the current requirement and important dates. And if you have any questions, you're going to reach out to Heidi Holt. If you have any changes or you're updating, or if your management has changed, you must resubmit. The Affirmative Fair Housing Marketing Plan for RPP is required prior to loan closing. You're going to upload that via RCRS. Be sure to include the applicable worksheets and other supporting documentation as required by the plan instructions. If you have any questions, you're going to reach out to Dorian. It's required prior to the loan. The management plan is required prior to the loan closing. Upload via RCRS. And if for any questions on this, you'll also reach out to Dorian. And again, if you're making any changes, updates, changing management companies, you need to resubmit. Tenant participation plan is only required if it's a CHOTO property required prior to the loan closing. Refer to the agency website for current requirements and reach out to Dorian for any questions. The grievance procedures is only required if it's a CHOTO property required prior to loan closing. Refer to our agency website for current requirements and questions. You're going to reach out to Dorian. And again, any changes or updating you must resubmit. Yes. I apologize. You are right. We are no longer requiring the management plans. Okay. So there is now an insurance tab on RCRS. So we're not having to upload that as of yet, but that is coming. Who's doing this next section?
We are giving 8823s out right now for trip hazards. So, all right, we're going to go through the home requirements now, and then we will take a break. So bear with me through one more section, and then we will take a break. All right. So we're going to talk about the home requirements. I will try to point out what might be coming, but the new home requirements for the new final rule that was released in April. HUD released the new final rule in April. It gives PJs a year to come into compliance with it. We are fine tuning our policy. It is 95% there. We just need to do some last minute crossing of T's and dotting some I's before we release it. And so hopefully within the next 2 weeks or so, we'll be able to release that because it will make some big changes coming forward. Again, some state agencies have already implemented it. Some of them are going to implement later. So if you are working in multiple states, be sure to know what each state is doing. So with the current home requirements, there is a low home income requirement where in projects with 5 or more home designated units, at least 20% of those need to be occupied by households who have an annual income that are 50% or less, which is what we learned yesterday is the low home units. The low home limits are typically below the tax credit income limits, but not always. You need to be very mindful of when they are not until January. And then in the high home or when household's income exceeds the low home at recertification, that unit is now considered a high home unit, which we learned yesterday is the 80% AMI, but Obviously, you're not going to go over the 60 if you've got normal tax credits anyway. So in a 9-unit building that is 100% home, how many units are considered low? Cheated. We got the answer. It's 2. So 2 of those 9 have to be under the 50% AMI. If you're also 100% tax credit, the remaining will be under the 60% tax credit limits. For high home income requirements, the high home designated units must be occupied by household members who have an annual income of 80% or less. But again, it will be 60 if you're tax credits. We do have a small handful of properties that are home only and do not have tax credits, so they can go up to that high home 80% limit. For the high home income limits, they, depending on the other restrictions that are in place, may exceed the tax credit limits. When high home exceeds the high home, or when households exceed the high home at recertification, that is when you trigger the adjusted annual income, and you have to do the 30%. They pay 30% of their adjusted annual income versus what the rent caps are. If less than 100% of the units are designated as home units, it is very advisable to designate another home or another unit as a home if the household exceeds that 80% at recert, so that you don't have to do the adjusted. This is another big reason that we require all of your home units to float, because you've had them, you've verified everything the exact same for every household. You've had everybody sign the home lease addendum. You have treated every household as it is a home unit. So you would just take that person who now exceeds the 80% and you're going to swap it with somebody who doesn't, so that you don't have to do that calculation of the adjusted for rent payment. The home income limits, you will see the home income limits that have 4 different income limits, but they only use 2 of them. It is information only to have the 30 and the 60% income limits. Home income limits are not held harmless, and they may decrease each year. In April, May, June, when the new home limits come out, you need to look very closely at your properties to make sure that you didn't get a decrease in your county. If you're really close to the income limits, you may have to reduce your rents. You also need to look very closely if you're close to those income or those rent limits when you update your utility allowance every year. Because if you've got a huge increase in the utility allowance, which we have seen year after year the last couple of years, they have gone extremely high because utility expenses are high. If you're close to the income or to the rent limits and you get a big increase in a utility allowance, you might have to reduce your home rents. So you have to be very careful with those. High home rent requirements, 80% of the home designated units must be at or below the 80%, which is the low income. Rent is limited to the lesser of the high home or the fair market rent or the tax credit rent when applicable. If the property also has tax credits, obviously you're going to remember that the high home units are restricted to that 60% AMI. The low home requirements, 20% of the home designated units must be at the 50% AMI. The rent is limited to the lesser of the low home or the fair market rent. We talked about the rent limits already. If to determine if rent is below the maximum home rent limit, you have to include the tenant paid rent, the resident paid rent, the rental assistance, the utility allowance, any of the resident paid utilities, and any mandatory fees that you may have at your property. That is what is included in the gross rent, which is vastly different than the tax credit world because we don't count the rental assistance in the tax credit world. This is one of those changes that is coming with the new home final rule, to where the rental assistance is not going to be counted in the gross rent, for home. So that is a huge win to help match the different programs. So after January 1st, when our new home policy, you can go ahead and mark in your book, this is one of those changes, with the new home final rule, that you will no longer count that rental assistance as the gross rent when it comes to home. We have a question. Yes, ma'am. No, you still have to, so don't, this does not, key will continue to be exactly like it has been. Unfortunately, we have read the rule until we were blue in the face because we would also like to do away with that. The question for TV land is, you have 100% home property, and you have the DHHS units with the key rental assistance. And right now you have to do that adjusted worksheet because you are 100% home. And because of the type of subsidy that it does not qualify under the home rules. So that is something that we will continue to have to do even in January, because it is not a rental assistance. It is a rental assistance, but it is not, the way that the calculations are and all of that, it doesn't count as the rental assistance that we would like it to count as in the system. The 811 is going to be different because that is a HUD program altogether. So we're talking strictly the key calculation worksheet when you are 100% home. Unfortunately, in January, you will still have to continue to do that on all of your 100% home properties that have key assistance. That is not going away. So these examples, again, are today, not in a couple months. So we have an example of a tenant paid rent is $200. The PHA pays $400 and the utilities are $100. The 1-bedroom low home rent limit is $600 in the current policy. Does this comply with the rent limits? The answer is no, because we're $100 over, because we have to count the rental assistance. So if the home funds are issued by the agency, the rent for the resident to be charged, the max rents, everything is listed in our CRS. The utility allowance changes must be approved by NCHFA. If the UA increases, it can cause the home limits to be exceeded and rent will have to be decreased. We talked about that a little bit already. PHA utility allowances must be used for tax credit households with the Section 8 vouchers. Another change with the home final rule is they are allowing the use of the PHA utility allowances. So it's another nice benefit. So that last note in January, you don't have to separate it if you would like to use the PHA utility allowance for the entire property. You still have to send them in for approval. You still have to send in the documentation. But on the home properties, you can now use the PHA utility allowance. And have any questions on the home section? We good in TV land? Yep. So it is 10:22 now. We're going to take a 15-minute break. And then we'll be back at, I can't add, just come back in 15 minutes. We'll be back.
Check 1, 2.
All right, we are back. We lost our friends virtually for a few minutes, so it took a little bit longer than our 15 minutes, but we are back. And we are going to talk about tax credit requirements, both federal and state tax credits. So what do we do here at the North Carolina Housing Finance Agency? We administer the federal and state housing programs. We are partners in affordable housing. We report to the IRS. And not everything that we report to the IRS is bad. We allocate the tax credits. We provide technical assistance for compliance programs. And we do a lot of other small things that are not listed. So for the tax credit program for the state, there is a qualified allocation plan. It is published annually. We do allow a comment period once we get the draft out, and then we put the final version out. This sets priorities for awarding credits. It addresses state-specific housing goals. It establishes the minimum threshold requirements. You can always do more, but this is going to establish what the minimum is. It establishes the selection criteria to the competitive scores with the tax credit program. It limits the amount of credits awarded to projects and the development entities. The current QAP and all of the subsequent years are listed on our website under the developers section. And then if you want to use the fancy QR code, it will take you there. Again, it is very important to know what your allocation year is because the requirements change every year. Some of the big things that were changed, like the supportive services, the targeting units, the key program. The key program wasn't a thing prior to 2004. Prior to 2004, they were actually considered targeted units. They're still considered targeted units, but they weren't key units. There was no key subsidy. You just had really low rents on those units. I remember a property that I had, the rents was $150 for a 2-bedroom unit, 1-bedroom unit, and they were as low as $300 for a 3-bedroom unit. There was no subsidy on those. They were just targeted units. They were the same demographics that our key program helps, but they were specific to that property, and they didn't float. They were just units. Prior to 2002 and earlier, you had supportive services. Back when it all first started, they were optional, and you got points for them. Then they became mandatory for the elderly properties, and then they became optional for points for family properties in 2002. That is when the targeted units came on board and you got points if you selected those. Now in 2004, we have done away with the targeted units. And now it is the key program. And for several years, those properties that had targeted units were still targeted units, and they didn't get key subsidy until way later in the game. So supportive services requirements, if they are applicable, here's the thing, if you got them, you have to keep them. You don't just get to make it go away just because they're not part of the new QAP. So if you're one of those earlier projects and you opted to have supportive services requirements, you are required to keep them for the affordability of the property. So if the plan is not relevant or the needs need to be updated to reflect current activities, you're going to submit a copy of the supportive or of the services plan to the agency for approval. We realize that things are not running the same as they did back in 1995, and times change, and sometimes our plans need to be changed. Documentation must be maintained to show compliance with the plan. Examples of that would be a services notebook, flyers, sign-in sheets, calendars. Don't confuse supportive services requirements with supportive housing development requirements. They are two completely different things. These supportive services requirements are on tax credit properties that opted to have them or were mandatory to have them in earlier allocation years, not supportive housing developments. So the targeting program and the key rental assistance, it's a partnership between DHHS and NCHFA and local communities. Annually, 10% of newly funded tax credit units targeted with persons with disabilities. Owners sign the targeting unit agreements or the TUAs. The people must be referred to your property by a service provider who has made a commitment to participate. Housing with access to support and services. You do not have to require on-site services. The key rental assistance is a state-funded operating assistance to subsidize the rent of residents referred by DHHS. And this kind of goes back to why they can't count as the home, is because it's not a rental assistance. It is a rental assistance, but that's not how it's calculated. Limited to households headed by persons with disability. So the head of household has to be receiving a disability source of income in order to qualify for the key rental assistance. That could be $1. And it is also very important that even on site, when you are verifying all of that, that you are verifying their disability source of income, because it may have changed from when they were referred. So don't always go based on what the referral agency said that they qualify, because things have changed and they may no longer qualify. They have to have a disability source of income to qualify for key assistance. The key payment standard is set by NCHFA and DHHS. They have already met. We have already published our 2026 key payment standards. Those worksheets are available online. And the owners must sign an agreement to participate. The management companies are responsible for verifying eligibility. Again, just you're not taking the referrals word for it or the referee. You have to verify that they qualify for the program. You are required as a management company to send NCHFA the monthly key requisitions on time. And if applicable, to transition them to a Section 8 voucher. That is the goal, is for them to not be on key forever and ever, but eventually to get them on a Section 8 voucher so that that key assistance can last longer and the program can continue. Don't forget the reporting requirements, especially if you are on the approved management company list, because it is vital. This slide, we're just going to change the dates because obviously we have been in 2025 for quite some time. But now the 2026 key payment standards are available. And the tiers were determined. No tiers, no counties changed tiers for 2026. So whatever tier you qualified for in 2025, you will still be in 2026. Nobody changed. All of these changes that you see in your book were what changed from 2024 to 2025. Moving to 2026, they are exactly the same as they were in 2025. All of the worksheets, 2026 and 2025, are available on the website. 2025 will go away December 31st. So January 1 will only have, by January 1, if you have not done your January research, just, you need to do them. And obviously no move-ins are going to be moving under the old payment standards. Again, everything expires. The old worksheets will expire. The system will automatically pick up the new payment standard January 1. When you submit the requests on or after December 1st, You don't need to do anything in RCRS to change the payment standards. Those are automatic. For move-ins on or before January 1st, you should be using the existing key calculation worksheets because the new payment standards don't go into effect until January 1st. For move-ins after, you're going to use the new worksheet. For research or update events not submitted to NCHFA but signed on or after December 1st, you should use the new calculation worksheets that are available. For any research or update effective 3/1 or later, there should be no exceptions to using the new updated forms. If you have any questions about the forms, you're going to reach out to Louise Gardner. I'm not sure why this slide is right here. This is a new slide that we added. The grace period for the final reports. We've done a file audit and a physical inspection. When we submit the final reports, you, as of today, have a 15-day grace period to respond to those to make sure that we have the correct information before we report to the IRS. January 1, that 15-day grace period goes away. We will remind you again when we talk about the final reports and the tips for compliance. But once the final report is submitted, that is when we are reporting to the IRS. Anything after the final report will have to be a compliance resolution packet. And I think we have a TV virtual question.
What if a referral isn't getting Social Security disability, but now getting straight Social Security? Do they still qualify for the key assistance?
So yes, if they qualified and had a disability source of income at move-in, we're going back to the key households. The key households had a disability source of move-in, a disability source of income at move-in, and now they have become of age and they are getting straight Social Security. They still qualify. Their assistance just switched. They are still disabled, and we're not going to make them move out or they're not going to lose their key assistance. Updating RCRS contact requirements. Each management company has an RCRS administrator who can assign contacts, roles, tags, and set user passwords. It is important to ensure that the management and owner contacts in RCRS are current for each project in the portfolio. We know that management companies and owner contacts change, so you just need to make sure that you are updating them regularly. Ensure that the contact roles are updated for each property as staff changes. These are the tags that are available in RCRS. It is important to remember that one person can have multiple tags, but each tag can only have one person. So you can only have one person as a key contact or a physical inspection contact, but that one person can wear multiple hats. You need to tag as many people as possible, or you need to use as many tags as possible. This is how we at the agency know who to talk to. If we have a question and you've submitted a rent increase or a reserve request and we need to know who the appropriate person to talk to is, we do get a little tag of who submitted it, but that is not always the person who is responsible. That could just be the admin person who uploaded the documents. We need to talk to the person who's over the financial stuff. When we're trying to schedule a physical inspection, we need to know who to contact. Otherwise, we are going to be emailing anybody and everybody and the owner and the Pope. Like, we got to get somebody, right? Key contacts, if there's a problem with your submissions, that team needs to know who to contact. Those contacts are also how the letters and the notifications get sent in RCRS. So when those file review notification letters get sent, they are only getting sent to the person tagged as the physical inspection person. If we send back those management documents, if we send back the rent increase or the reserve request, it is not going back to the person who submitted it. It's going back to the person who is tagged as the financial person. So make sure that they are updated and that you are using as many of the tags as possible. One of the biggest is the on-site contact. We will actually cite this as non-compliance if it is not used. If we are driving to your property and it is 3 hours away and we can't find it and you don't have anybody listed as the contact, because sometimes GPS doesn't work. Sometimes addresses don't come up, especially with new properties, right? The addresses aren't even in Google Maps or Apple Maps. And if they're not changed, we don't know who to contact. Or when we get to the site and there isn't anybody there. That happens way more often than you think. We need to know who to contact. So the on-site contact is one of the most important because you can actually get cited for non-compliance for not having it updated. If you need assistance with any of that, reach out to compliance help. We have a comment or a question? Comment? So the comment made was actually by one of our inspectors, just reminding you to also make sure that the address in our CRS is the correct address to the property. We will get sometimes where you've put the address to the home office. I'm not going to the home office to do your physical inspection. I've had it to where the actual site was an hour and a half away from the address in our CRS. Also, in development, when the addresses are not legit addresses yet, and they're on the corner of A Street and 7th Street, we need to update that. We need to make sure that we get the correct address when it is a legit correct address. So those are 2 instances that I personally have witnessed. So it's another step, making sure your contacts are correct, but making sure that your addresses in the system are correct. And if you need assistance, you can reach out to compliance help. So submitting documents, and this is with file audits, utility allowance, tenant selection plans, inspection responses, targeting documents, forms, rent increases, reserve requests, really any document that needs to go into our CRS. You're going to upload that into our CRS. You are not going to do what? You are not going to email it. You are not going to send us a link to some Dropbox that's holding every document under the sun. And you are not going to upload a link to a Dropbox into our CRS. You are going to upload a PDF into our CRS, and you are going to open that PDF before you upload it to make sure that it's not a corrupt file and to make sure all of the pages are there, to make sure that they're legible, to make sure that they are the right side up versus upside down. The amount of time that we spend on files and PDFs that are not legible, or that I have to flip every page in a 100-page document that is out of order and half of them you can't read, is unbelievable. So please do your due diligence. That's a lot of words. Those PDFs before you upload them. Please open them. Please make sure that you can read it. If you can't read it, I can't read it. If you can't follow it, I can't follow it. And don't email them. Now, if the document is too large to upload into our CRS, that does happen. There's a 10 megabyte rule. It has to be under 10 megabytes. You can reach out to compliance help and we can assist you in reducing the file size. We find that a lot more in responses to reviews where you are sending us way more information than we need. Only send what we ask for. But if you need help reducing the file size, we can do that. But we are going to email you that reduced file right back and tell you to upload it into RCRS. You emailing it to ask for assistance to reduce the file is not responding or uploading it. You still have to upload that into RCRS. So the role of the IRS is to perform three major functions: tax returns, taxpayer services, and enforcement. They regulate and enforce the requirements for the tax credit program. Enforcement involves recapture of credits due to program noncompliance. It establishes the tax credit program requirements and provides program reference materials. There are different types of tax credit developments. We've got new construction, a substantial rehab of existing units, an acquisition rehab, which NCHFA requires a set dollar amount per unit of rehab costs that can also be found in the QAP, and those change every year. Credits are allocated based on a competitive application process. Again, all of those requirements are in the QAP. The states are required to allocate at least 10% of the annual credits to projects sponsored by nonprofits. So we have to allocate at least 10% of our stuff every year to a nonprofit organization. And then they are awarded under the state's QAP, which we have talked about many, many times. And those are again available under the developers tab of our website. Big form in the tax credit world is the 8609. This is the official notification to the IRS for your allocation of tax credits. This form is issued for every building. So every bin number gets its own form. The owner makes a required election on part 2 of the form. Those forms, we fill out part 1, we send it to the owner, they fill out part 2, they send it in with their first tax return, and then you're going to upload the completed form into RCRS. The failure to upload into RCRS under the properties documents will result in noncompliance. Obviously, we have to wait for the credits to be, your first year credits to be filed. So you're not going to get that noncompliance right away when the property opens, because there is some lag time from the placed in service date to when the owner actually files those. But once that happens and you have the completed 8609, you need to make sure that it is uploaded into RCRS. Did I miss a page? Oh, part 1 of the form talks about the name, address, the taxpayer, or the tax identification number. It's got the bid numbers listed. It's got the amount of credits that were awarded, and it's got the placed in service date listed. Line 7 is the eligible basis. Line 8B is a very important box. And you need to know at your property what was checked for line 8B. It determines a lot for your property with multiple buildings. It really does nothing for your properties that have one building. But 8B, checking yes in box 8B, will result in each building being considered a separate project. So while you might have Fair Village Apartments, if you have 10 buildings and on these 8609s, your owner decided to select yes, each one of those 10 buildings is a standalone project, which is a headache. So that means each building has to meet the set aside. Anytime you transfer, you can't transfer between buildings because You have to move somebody out of one building and move them in to another building. So we'll take that example of an over income household. Remember, they moved in, they qualified 5 years later, they've made more money, they're over income. They would like a downstairs unit. The only one available is 2 buildings over. And your owner has selected yes on line 8B. You now have to tell that tenant that they don't qualify to live at the property that they've been living at for 5 years. They can stay in their second floor unit, but they can't move to a first floor unit unless one comes available in the building that they currently live in. So line 8B makes the world of difference, and it is very important that you know, especially on the site level, how to handle certain situations based on how that is elected. Yes, ma'am. So the question is, if you have line 8B and they've selected no, so each building is all one project, are they allowed to place in service on different dates? The answer is yes. Every building places in service differently, but the placed in service date is always going to, like, for the your tax credit purposes, are going to be the last one. So the question is RCRS going to show anything different if 8B says yes or no? And the answer to that is no. The only form, yep, the only way to know whether you have selected yes or no on the 8609 is to look at the 8609. There is nothing in RCRS that indicates whether the owner selected yes or no. The bin numbers, so the comment is asked if there was a question about the bin numbers, but every property or every building, no matter if you select yes or no, has a different bin number. So every building at a project has a different bin number, period. That won't indicate whether they've said yes or no. We have another question back in the back. So what was in TV land, it was brought to the attention that the word on the slide may be backwards based on the words of the 8609. We will look into the slides to make sure that they match correctly. But the moral of the story is on the 8609, if you have elected for them to be separate projects, you need to know how that works. And if you have elected them to be one multiple project, you can move people around. You can do all of that. If you have despite whether it's yes or no, you need to be aware whether it is one project or whether each individual building is its own project. One more question. Correct. 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 So if for TV land, The comment from the audience is, depending on who is looking at the 8609, good could be the opposite. So for the investor, they want each building to be separate because they want to be able to get the credits faster. They don't want to have to wait for the entire property. This is going to come into play if you place in service towards the end of the year. If you're placing in service in January and all of your properties are coming on board, then it doesn't really matter because you're going to claim the credits at the next at all at the same time because everything placed in service in the same year. But for a management company, they don't want it to be multiple buildings because it is a whole lot more work compliance wise. So depending on who is looking at the 8609, is going to determine whether it's good or whether it's bad, or when they place in service, the time frame and that kind of thing. The key is to understand what is selected and how that works on a property level and for compliance reasons. Yes, sir. Mhm. So the question is, does the 8609 have any effect on how we handle each building for like a physical inspection? And the answer is no. The project is still the project as a whole. And so no matter what you have picked on the 8609, we are going to treat Fair Village Apartments as Fair Village Apartments, and we're going to inspect the whole thing. It really comes into play just for the compliance and the qualifying and meeting the minimum set asides and that kind of thing. But once you are up and running, the physical of the property. So building one is not Fairview building one. I mean, you're not Fairview A and B and C and D. Each building does not have a new name. It's still one entity. But how they are treated as far as the meeting the minimum set aside, delivering the credits and the investor getting their credits, moving people around per building. Those are the things that line item affect, not the typical day-to-day of the operations. So line 10A is the year that the owner elects for the first year to be the credit period. This is another big, very important thing to know on a management side, because you need to know when you can, like when it ends. That first year that they select, that is when that 15-year clock starts and the 30-year clock starts based on when they've gotten their credits. And line 10C, this is where you're going to elect the set aside type, whether it's a 50, a 20 at 50, a 40 at 60, or whether it is average income. Instructions, if anybody needs them, on how to complete the form are listed. Compliance periods, the credit period where the owners are going to claim the tax credits for 10 years. You are in the compliance period for 15 years. So it's an accelerated credit period. The owners get it in 10 years, but you have to be in compliance for 15 years. And then you have an additional 15-year extended use period after that for a total of 30. The credit period and the compliance period start that first year that the credits are claimed. Okay. Again, it is very important to know what year your property claimed its first credits. For instance, if you have a multiple building property and you have your first placed in service in November, Your second building, it's a 3-building property. You've got your first building in November, you got your second building in December. Something happened. Building 3 didn't happen until February. It happens a lot. And you have elected that it is a multiple building project. You cannot claim credits until February of that year. So if you had building 1 and 2 leased up, or not even leased up, they placed in service in November, December 2024, and you've got your third building that didn't happen until February of 2025. If you selected they were all the same project, your first year that you could claim credits isn't until 2025. If you selected that they are separate, you could have claimed credits for 2024 and then your third building in 2025. But now the owner has to wait if they selected the other. That is how that line works on the investor developer side. And important to know when that compliance period starts. So the extended use period, you have an additional 15 years after the compliance period. You must comply with the deed restrictions in that time period. That is a state enforcement. There's no recapture of credits after that 15-year compliance period. You can only terminate that 30-year period for a foreclosure or qualified contract process. The policy for the extended use period, you must fully document eligibility at move-in and first annual recert. No additional recerts are required. Again, look at your other funding. This is for tax credits. Student rules no longer apply. Again, talk to your owners before you just stop looking at student status. They might want to come back in the future for a new allocation in which you would want to continue that. That is a rule that even though you don't have to do it, 90% of people still continue to do that. Compliance is reviewed project-wide, not building by building. And when you're in the extended use period, we do a smaller sample size. So instead of the 20% every 3 year, if you're a full tax credit property, we do 10%. I think we have a virtual question.
In the extended use period, is the property still required to participate in the targeting program?
The answer is yes. So research by funding program. For a 100% tax credit property, you are required to do a full annual recert the first year after move-in. You are required to then update annually after year 1, so year 2 on, the household composition, student status, and the amount of rent being charged. For a mixed income property, this is going to be your tax credit properties with home funding, with National Housing Trust funds, with state housing trust funds, any other funding that the agency gives outside of straight tax credits. You are required to do a full annual recert every year. In the extended use period, 100% tax credit, you're required to still do that full year recert. You are required to do the household composition and the rent being charged, but you're no longer required to, again, do the student status. Talk to your owner. For a mixed income property, in the extended use, you're required to do the first year anniversary. Again, the annual updates. For properties with average income, while they are 100% tax credit, you are required to do an annual recert every year. If you are average income, you don't get to follow the same rules as if you were a regular 40 at 60 or 20 at 50. You have to do a full recert every year. If you have any RPP funding or any other agency loans, you have to do a full recert every year. Again, it is important to know the funding at your property. Tax credit program requirements. 100% of the units in a project can be targeted to low income households or smaller percentage. This is where that, again, you've elected the 20 at 50 or the 40 at 60. The percentage is the applicable fraction and is recorded in the LORA. Projects are subject to the IRS and state regulations for 30 years or more. Prohibits evictions for tenant or termination of tenancy for other than good cause. Prohibits the refusal to lease to Section 8 voucher holders based on being a voucher holder. You can, if the local housing authority or the local voucher giver is not willing to pay what you rent your units to non-assisted households, you can refuse the voucher if they are not paying your rent standard. Now, you cannot charge them more than you're charging. You cannot refuse to accept a voucher if you've said pay me $1,600 and you're only collecting $1,100 on your unassisted households. But if they are only willing to pay you $900 and you're getting $1,100 for your unassisted households, you can refuse to accept the voucher if they're not paying your payment standard. But you cannot refuse a voucher holder just because they are a voucher holder. Tax credit, there's a vacant unit rule. It's a project-based rule. It focuses mostly on mixed income properties. Non-compliance in violation of the vacant unit rule is reported as a category 11J, if anybody wants to get fancy with the 8823. And that is if the owner fails to make reasonable attempts to rent low-income units before renting market rate units. It can be documented using marketing efforts, timely processing of low-income applications. This is just a reminder that North Carolina has a vacant unit policy effective January of last year. Vacant units over 6 months, whether they are rent ready or not, with no scheduled move-in, will be cited as non-compliance and will remain in non-compliance until they are rented. And we will look at the move-in to make sure that there was a lease that was signed for that unit in order to correct that non-compliance. The 140% rule, this is when households' income exceeds the 140% of the current income limit at recertification. That is considered an over-income household, but we already know that in the tax credit world, they're not required to move once they are over income, but the next available unit must, and the available unit rule must be followed. So this is where if you've got a household that meets that 140%, they're considered over income. Your next available unit must be rented to a low income household. You can still run into a problem even if you are a 100% low income household if you are not being very careful with your calculations and you have somebody who is over the income limit and you miscalculate income and you move somebody in over income, you can still violate the next available unit rule. It's just less likely at 100% low income property versus a mixed use property. Recertification income limits is 140% of the current tax credit limits. On the tick, it will show what the 140% limits are, so that you can easily match whether they are considered an over income household. A current 60% unit, a two-person income limit is 24,720. At recertification, that limit would be 34,608, which is 24,720 times 140%. And if this household's income would exceed that 34,000, then this unit would be redesignated as a over income, and you must follow that next available unit rule. The unit remains eligible for credits as long as the unit remains rent restricted and units of comparable or smaller size in the building are rented to eligible households until the building's applicable faction is restored. Again, a lot of the next available unit rule is going to come into play on a mixed income where you've got market rate units. If a unit of comparable or smaller size in the building is rented to an ineligible household, then all over income units in the building lose their low income status and are no longer eligible for credits. So at 100% tax credit property, owners must have policies and procedures in place to ensure that all units are initially occupied by eligible households. So in this one, this vacant unit must be rented to a qualified low-income household. So how does the next available unit rule work with multiple set-asides? Units with deeper targeting, those are going to be your 30s, 40s, 50s. Way back when we even had some 35s and some 45s. We'll use the project-specific income limits from RCRS and apply that 140% rule to their specific set-aside at recertification. For the deeper targeted income set-asides, when the household income exceeds that 140% of the current tax credit unit, the unit designation is changed to the next higher set-aside. So if they're at a 30% and you go over the 140% of the 30%, if you have 50s available, you would move them to a 50%. The next available unit must be rented to the lower set-aside to restore compliance. And that also goes back to, you don't want somebody making $75,000 a year to be paying $450 a month in rent in a 30% unit. We are so glad that they qualified and that they got a promotion and job change and they are doing much better in life. But we would like to give that 30% unit to somebody who actually needs that 30% unit. So income limits, 30% unit is 14,000, 50% unit is 24,000. Our new move-in is at 12,000. At annual recert, they're at 18,000. What is the income set aside at recertification? Heard one. Let's see a show of hands. Who's at 30? Who's at 50? I saw like 5 hands. There are way more than 5 people in this room. So at recert, we take 140% of the current set aside. So 14,640 times 140 is 20,496. Let's play the game again. If you think they're at 30%, raise your hand. Confidence, y'all. If you think they're at 50%, raise your hand. Okay, I still see 5 hands. They are a different 5 hands. Y'all just don't have confidence or you're just not awake. Is 18,500 more or less than 20,496? It's less than. So this household remains at the 30% set aside until it exceeds that 20,496. Now, next year when they do it, they may have gotten a raise and now you may move them. But they're going to remain at the 30% until they go past the 140. So even though they would have income qualified under the 50 if they moved in and they wouldn't have qualified at the 30, you're going to keep them at the 30 until they go over the 140%. Okay. So employee units. uh, employee units are low income. You've got two different types of employee units. Okay. We're going to talk about the low income eligible ones. These units are occupied by full-time managers who are also qualified to live there. And they are treated just like any other eligible household. So they are going to certify to live there like anybody else. Agency permission for these units are not required. They're a household like everybody else. The unit is included in the unit mix. Rent can be charged because, again, they are a household just like anybody else. These households must follow the property rules, including recertifications and student status. So if it is a low income eligible household, this manager would qualify to live there just like their neighbor. They're paying the same rent. They're following the same rules. You don't have to get our permission. They just live there. Now, if you have one of those employee units that are not a low income unit, these are occupied by that manager who would not otherwise qualify to live there. These units must be, they're only eligible if that manager is considered reasonably required by the property. The unit is no longer classified as a residential unit. The unit is not included in the numerator or denominator of the applicable fraction. Agency approval is required, and you cannot charge rent for those units. Again, difference, low income, they're paying rent. They qualify to live there just like anybody else. They just happen to live on site and work at the property that they live at. If you are not a low income household, you cannot charge rent. They have to be a full-time manager at that site. They cannot be the full-time manager of 5 different sites. And you have to get agency approval. Okay. Employee units must be updated in RCRS at move-in annually and move-outs. The 30-day unit events still require. And it sounds like we might have a question in TV land.
In the units that the manager qualifies the unit, if they are receiving a rental discount, does that discount have to be applied to any other income?
Does the rental discount applied to the income? You're going to calculate income just like you would anything else. That concession that you are giving that manager to live there is just that. It is a concession and has nothing to do with their annual income to qualify. If that answers the question. If that doesn't answer the question, please clarify and we can readdress that. Yes, ma'am. You need to talk to your fair housing attorney. The question was, how does that concession meet the fair housing requirements? There are times that you might run specials at your property where you have a season where you do give specials to a certain set of move-ins where they weren't available at others. So you would just need to talk with your fair housing attorney if you have questions about that particular situation that might address a fair housing issue. Any other questions on employee units? Perfect. We're going to talk about student rules. Households consisting entirely of full-time students. Okay, we're going to pause on student rules for 1 second. So the question is, can I go back to this slide where nobody wanted to participate in my mini game? So the question is, this household that is now over the 140%, so they are not currently, they're 30%. And next year at Research, the same household on this slide gets another raise and they are finally over that 140% rule. And so they would be well over the 30% and they are using the same numbers. They are almost over the 50% limit, which means the question was if they can't afford the 50% rent, and you don't want to evict them because they can't afford the rent. They're almost over the 50% limit, which means they should be able to afford the 50% rent because they're, uh, so it is, there you go. You're going to move them to the 50% set aside. Because you have to rent that 30% to somebody else. Collecting of the rent is a different, that's the mess that you have to have your management company clean up. But you are moving them. You can't not move them because they can't afford the rent. That is also a personal, we are not managing our money appropriately, potentially, because they've been paying the lower rent for so long that they feel like they have. But a conversation to have with this said tenant, they're coming really close to being moved to the next set aside. And you generally know that before it happens, right? They don't go from 12,000 to next year. It happens. We do have households that go, and we as auditors have to double and triple check to make sure that they really did go from 30,000 to 70,000, like it's legit. And so I know you guys see it on site. Typically, you don't go from $12,000 a year to $21,000 a year in 1 year, right? So next year, you've done that research, they're at 18.5, and you're having a conversation with them that this is where you're at. And in the next year, you may be going to that next set aside and you're having those conversations ahead of time when you can to avoid the big lash of I've only been paying $150 for 10 years and now that all of a sudden you want me to pay $500. I can't do that. So you need to have those conversations as early as possible. So we're going to skip our slides again and we're going to talk about student rules. So households consisting entirely of full-time students are not eligible unless they meet an exception, which we cover in Compliance 101. Do we have any questions? We're good? Perfect. I think, Stephen, is this you? Okay. Huh? We are, yeah, we can do it now.
I know we're close to lunch, but before we do this section, huh? You can't hear me? Is that better? I'm not a TV evangelist. Unless you got $400,000, I can swipe from your church. I know, right? Oh, we are on live stream, right? But none of them are watching. So average income can be scary. When we came out with our initial policy, I think some in the leadership have said before they tried to make it difficult so people wouldn't choose average income. And that didn't work because that very next application period, almost everyone selected average income. Owners in the room, saw money. The management companies saw problems. And so we were right there with you guys. I do think we have a good policy. Our policy is clear. Our expectations with our policy are a little bit more stringent than some of the other states, but our policy is a strong policy. We've done a good job, I think, as far as publishing that policy and covering that policy. Sandy used to do this section in the trainings the past couple of years. I was at the Costello conference a year ago in Florida, and a owner or an investor actually had came up and said, we haven't done any average income deals in North Carolina because your policy is really strict. And I went on and it said the same thing to that individual, that we have a well-documented policy. We've covered it. We've helped with it. And it actually, you shouldn't be afraid to do average income in North Carolina because to date, and Susan can let me know if I'm still correct on this, we haven't written up any non-compliance for any properties dealing with average income. Is that still correct? We haven't issued any non-compliance. And that's because we've been proactive to cover our policies, but also when something arises to work with you on it so we don't have an issue. So we're going to play a game. It doesn't have to be scary if you know what to do. So we're going to talk about trust because that's one of the big issues with this policy and any other policy is trusting everyone in their role, the owner, the compliance staff, and the site staff. So I need 8 volunteers. You can look away, but you can come on up front. It's voluntold. Which one of these did you say? The one with the glasses. You can come on up too. So you can sit in the chair or you can stand behind the chair. We just need one management company. That's it. Kim, do you have anybody here with you? Who has a management company where you have more than one person here? How about you? And who's your coworker that's here with you? Pick one of them and come on up here. How about you? Y'all too? Just you and one of your friends. Okay, you and one of your friends. And then Stephanie and well, it applies to you because you're the one that's checking that box on that application. Okay. Here you go. Excuse me. Y'all decide who sits, who stands. You want you? Well, you can trade with a friend. So you have to have trust in your coworkers, correct, to get average income right, to get HOTMA correct, to get Inspire correct, all these new programs, correct?
Yep.
Take a cup and put on her head. Take a cup and put on her head. upside down so it'll sit.
Yes.
Did y'all hear that question? Oh, y'all did. Okay, I want to make sure. Okay. So if you don't know the policy, try knocking that off her head. Yeah. And you do it. And you can hit her in the head because the cup's real small. But don't, I'm saying, if you're not properly trained, that's what it looks like, right? How about you? There, well, you did good. You knew enough to get by, and you did too. But if you're properly trained, it's a lot easier. There's a lot more trust between your compliance staff, your site staff, and your owners. You shouldn't hit no one in the head unless you're just mean and evil. Yeah, you can go. See how much easier it is when you're trained? Makes it a lot easier, right? You can drop your pool noodles unless you're going swimming during lunch. Thank you, guys. That's all we had to do. So training makes the difference because your cup increases in size because of the training that you had. So that makes a little fun, I guess. So we'll get back to our training now. And I didn't bring my glasses, so y'all have to bear with me. But we're going to go through this quicker than what Sandy went through with it. So this is the income averaging policy. It was updated in 2022. So then we updated our policy as well. Our income averaging policy varies from different states. Like I said before, it's only allowed on new construction, so you can't choose average income on a rehab. Your applicants electing to use income averaging must comply with the following. The income averages for the property cannot exceed 60%, as well as the income average for any bedroom type cannot exceed 60%. Market rates are not allowed on a property. You have to be 100% low income for all of your units. And then for projects with more than one building, the owners must select to treat each building as part of a multiple building selection. So when Randa talked about the 8609s, you're automatically going to check the box there to treat it as multiple buildings. You have no choice. And then there are the income bands that are allowed. You can only select 4 of them in our state. And that just makes it easier on everyone. And then any project utilizing the income averaging will pay a higher monitoring fee because you're going to have us coming out on an annual basis, as well as we're going to do file reviews every year. And you're going to do full recertifications, as Randa mentioned earlier, every year, not just the first year, the initial research, but for every year, you're going to do a full recertification for these properties. There are some additional compliance monitoring requirements. There's a couple here, and I'm not going to go through each one of these because we're getting close to lunch. So we have a annual recertification example. The move-in is $18,500 at 30%. Your first recert, it shows that they're $25,900 at 50%. They got a raise. So you must, the next unit must be rented at 30% AMI to restore compliance. And that's kind of what Randa talked about earlier. Low income certification review frequency, increase the annual review to monitor compliance with this particular set aside. And then the fourth one is lower set asides must follow the multi-family tax subsidy, MTSP, income and rent limits. The fifth one is part of the annual review, the certification. The agency will test the compliance that you have here. And then there are 5 allowable reasons to change the designation of a unit. And that's because it's federally permitted changes, such as a change that comes out with the IRS. agency permitted within our policy. And then certain laws such as fair housing, we will let you change the designation. And then tenant movement, when a current income qualified tenant transfers to a different unit in the same project, the units just swap status, and then to restore compliance. And that's where we're willing to help you get back in compliance so we don't have to issue 8823s or federal noncompliance. This is what it would look like on your results letter, but we are going to work with you before we get to this point so we can help you avoid noncompliance. If it were to reach the final results letter, this is what it would look like. But as a reminder, we never expect to see a minimum set-aside violation based on the final guidance from the IRS. So this is just a very brief training on income averaging. If you remember, Sandy used to do this training. She had a whole bunch of examples, went through it very thoroughly in detail. If you go to our YouTube playlist on our on YouTube for our asset management, you can find a recorded training of that and watch it if you need assistance with that. There's some other trainings up there as well, but this particular one, this is what it looks like. And you can view it on our YouTube playlist. So are there any income averaging questions? Everybody good? Anything in TV land, Krista? Are we good for lunch now? Okay, we're going to take lunch and we'll be back in an hour and a half. Send out some lollipop, I probably shouldn't have bought dum-dums that I should have. Tootsie Roll Pops. So how many of you remember Sandy in our trainings? She was with us last year. She always has this expression that, or something she says, that she says the quiet part out loud. So how many of you have said something similar to when a new policy comes out or somebody asks you to do something from corporate office and you say, this sucks? How many have said that before about your job? Susan Westbrook raised her hand, so everybody can raise your hand. So are you raising both hands? So instead of saying that out loud about something we don't like, we're going to take our lollipop and we're going to put it to use. They could if you don't know what you're doing. So Shannon's question was, is this next section going to suck? And my response to that is, with acquisitions and rehabs, if you don't know what you're doing, it might. But we're going to be professional and we're going to move right along. And then after lunch, you kind of need something to keep you awake the rest of the day. So, all right. So there, and I should have got my glasses. That might help too. That way I don't make nothing up. It is better when you make it up. What's better is when you can make it up and get away with it. Susan's going to run an errand to the grocery store for us. She won't hear none of this. So types of rehab projects, Randa kind of touched on this earlier today. When we're allocating funds for acquisition rehabs, this is where an owner purchases a property and then they rehab the property. So that's the acquisition. Then we have a rehab only. That's when an owner owns a property that they had previously purchased or they've owned it, and then they rehab it and they retain their ownership. And then adaptive reuse, that's when they take non-traditional apartments and they turn it into housing. It might be a hospital, it might be an old school, something of that nature. We have a lot of those in the eastern part of the state, and we have a lot in the western. I can't think of anything in the Raleigh area that's like that. Greensboro has a couple of mills. Kinston has some hotels, bless you. Kinston has a hotel. They have a old school. They have who? Yeah, that, and they had there used to be a school in Kinston, and they had the teachers' housing, and they turned it in. Is one of those your properties? Oh, you just know about them too? Yeah. I understand. When I worked for a syndicator, there were a lot of properties in South Carolina that were that way. And one of them was an old hospital, and they didn't do anything with the basement. What's wrong? Did I do something?
No,
It's causing feedback. Probably because I'm moving around. But it was a hospital, and they didn't include the basement in their allocation, part of their applicable fraction or whatever. And it was the morgue. And so nobody had been down there. You know, me, typically in the white movie, in the white people in the movies, I said that part out loud, didn't I? Y'all were thinking it though. So I went exploring, and the manager let me, and the regional let me explore. So one area downstairs was the morgue, and it was still like it was. So it was like going to a haunted house. The other area was the insane asylum. And so they still had the shackles on the wall. Huh? No, I went with the regional. But it is funny with some of the hospitals, they turned like the morgue and places like that into apartments. Who wants to live in the morgue? It's Halloween every day there. But anyway, adaptive reuse, that's just to preserve something of historical value to the community that's there. And then the owner selects the placed in service date. New construction, that's when, from the foundation up, that something's built. Acquisitions is where they use the allocation to purchase properties as well. The date of the acquisition by purchase is the placed in service date. And then for new construction, this is supported by the certificate of occupancy. And then rehab credits can be placed in service at the close of any of the 2-year period over which the rehab expenditures are made. We're not going to talk about physical inspections per se today, but me and Heidi have started doing some of the initial inspections for rehab properties and for new construction. One of the things when we come out, we're looking for that sprinkler system, those building inspection reports. And oftentimes we will be told that they're not available because they haven't been done yet. Well, in order to get the CO for your building, you had to have your elevator inspected. You had to have the fire alarm inspected. You had to have the sprinklers, the backflow in order to get your CO. So you have it. It might be that you need to get it from your construction company. So just keep that in mind. Resyndication, this is when an existing tax credit property receives a new allocation of credits. The building identification numbers stay the same, and the new allocation is layered over the original. So sometimes you're still in that affordability period, the second 15 years, and you come in and get a reallocation of credit. So then you're going to have two QAPs that you're following as far as your requirements until that initial 30-year period expires. Yes.
So on the acquisition, we have, it will have a new owner
Right.
entity, but technically we're still the same management, still the same owner, in all general purposes, but it will
Right.
have new entity owner. So what will we do with our CRS? Will that just kind of it'll be a whole new project inside of our CRS? Or will the current data that's in our CRS just be converted to the new owner entity?
Okay. So the question is, you have an existing property with credits, and then you get a new allocation. do you get a new property to show up in RCRS, or is it the same property that stays? And I believe it stays the same. Is that correct, Susan? Oh, Susan was down at the grocery store. We have an existing property. And they go in for another allocation while they're in the extended use period or even out. Do they show a new property in RCRS, or is it the same property? Is there any way you can tell? How can like, I know I can tell by going in, looking at the notes and going in RPM and all that, but how would like Shannon go in and look on her side? Okay. And that's going to be for your first file review and that initial inspection. Any other questions? Anything in TV land? Oh, good. The property is subject to both sets of requirements until the compliance period for the original allocation expires. If the property is located in an area where the income limits have decreased in the past, the property will be required to reduce the income and rent limits on the new allocation, causing a reduction in the rents and a change in the screening criteria. And then the new allocation will be created by development in conjunction with asset management due to there's two allocations of credits that are still into play. Everybody good with that? Households occupying units prior to an acquisition, if the initial tax credit income certification is completed within 120 days after the acquisition, the effective date is the acquisition date. Use the income and rent limits effective on the acquisition date. And then if the income certification is completed more than 120 days after the acquisition, the household is treated as a new move-in and to use the income and rent limits on the effective date of on the TIC. Households who move in after the acquisition but before the first year of the compliance period, the income certification is completed using the income and rent limits in effect on the move-in date. The test purposes with the acquisition and rehab, within 120 days before the beginning of the first year of the credit period, income of existing households must be tested. The test consists of confirming with the household the source and amounts of incomes that are listed on the TIC to make sure that they're still current. And it is not necessary to complete third-party verifications on this. If the household is over income based on the current income limits, you apply the next available unit rule that Randa talked about earlier. For previously qualified households, the owner receives the credits for the acquisition and rehab during the extended use period. We strongly suggest re-qualifying the household instead of relying on the original documentation that may no longer be acceptable or available. If the household is over the current income limit and won't qualify currently, then it's okay to accept the original documents if you have those. However, vacant units at the time of acquisition are not qualified units, and they won't be qualified until you have the move-in take place. So let's look at this. A property was acquired on 4/1/2025. In order for the TIC to be effective 4/1/2025, all in-place residents must certify by what date? 120 days, which is going to be July the 30th, 2025. We got a property that was acquired on January the 1st, 2025 for new move-ins that take place on or after that acquired date, January the 1st, 2025. What is the effective date of the move-in in this particular situation? That's correct, the date that the move-in takes place. When completing the certification test for in-place residents, the owner must obtain third-party verification. True or false? False is correct. Previously qualified households with the acquisition and rehab properties prior to the allocation of the acquisition and the rehab credits, the owner allowed students. Remember, we talked about that yesterday, not moving in students unless you had that conversation. Are student households that do not meet the student rule grandfathered in under the previously qualified rules? No? What you say? No? Yeah. What you say? No or yes? You, yeah. Joy. Okay, you heard no. Okay. Kim? Miss Norris in the back? Oh, and you're owners and you pay a management company so you can get away with that. So yes, the answer is no. They're not qualified. They're not grandfathered. That's why it's very important you have that conversation like we talked about yesterday. Are there any questions? We get involved in making sure you're in compliance. The best individuals that are going to help you in this process is going to be your syndicator, because they're after those credits and they want them protected. And they will let you know if you do something wrong very quickly. And there might be a penalty fee they charge you if you do something wrong. Right, Shirley? Not that you never had that done before, because you do everything right.
I do know.
Because you attend our trainings. Okay. RCR's questions go to compliance help. That's the truth. That's in the front of the book too. Okay. Who's next? Am I next? Am I next or is it Randa? It's Krista. See how they try to pawn that off on me? I was like, yeah, that's not going to happen. I know a little something.
So HUD publishes the income and rent limits annually for affordable housing programs. For Section 8, for LIHTC elections, the HERA special, home limits are published separately. New changes will now be published annually following release of federal poverty guidelines by DHHS. All properties that placed in service prior to January 1, 2009 use the HERA special income and rent limits, if any. All properties that placed in service on or after the effective date of the current income limit chart use the MTSP income limits. They are not eligible for HERA special income limits. Properties that placed in service between January 1, 2009 and effective date of the current charge will use the highest MTSP chart applicable for income limits. These properties are not eligible for HERA special income limits. Income limits are held harmless, which means they will not decrease after a project places in service. The 2025 income limits have already been posted, and RCRS does not have the ability to display separate effective dates. So although your home limits and your regular MTSP limits may be different dates, they'll all have the same date in RCRS. HUD Section 8 limits are used by properties with project-based Section 8 rental assistance. Income limits may decrease. Adopted by the home program, however, they cannot be used for home purposes until released by CPD and labeled as home income limits. Home rent limits are published separately. The MTSP and HERA special income limits. The MTSP, which is multifamily tax subsidy program, for use with the tax credit and tax exempt bond programs. Whether to use the MTSP or HERA special income are determined by the placed in service date. Income limit reminders. The income and rent limits are listed by county or metropolitan area. If the property is in a rural area, the property is eligible to calculate income and rent limits using the national non-metro median income if higher. Much of North Carolina falls into this category. Tax credit properties that are layered with other affordable housing programs, Section 8 RD home must use the most restrictive income and rent limits to maintain compliance with all programs. For example, if the property is home and tax credit, the tax credit income limits will likely be higher than the home income limits. Properties not electing average income on IRS Form 8609 will use the state mandated deeper targeting income and rent limits. The agency will utilize the highest of the income and rent limits published by HUD to determine deeper set-asides. Therefore, there will only be one income and rent limit applicable to each set-aside in a given county. With low-income housing tax credits and Section 8 home, which income limit is used for a two-person household? So you're going to use the Section 8 because it's lower. You're always using the most restrictive of the two. Income limits are available in RCRS. To make compliance easier, North Carolina Housing Finance Agency publishes property-specific income limits in RCRS once they are released. If you follow the income and rent limits in RCRS, the property will not have a compliance finding for using the incorrect income limits, even if RCRS is wrong. So make sure that you print those out and keep them with your property folder so that if something happens and they were entered wrong, you have your backup documentation as to why you used what you used. Does everybody know where to locate your income limits in RCRS? Okay, so you're going into property menu, click on that and go down and find it. And over to the right of the screen, if you click on the date, you can go back and see previous year's information. Are there any questions? Stephen, are there any questions in TV land? Because you didn't do your job.
She forgot I get a chance with the microphone now. All righty. So we're going to talk about rent and utility allowances now. Collecting the community spending money, hopefully. Rent reminders, rent increase requests, and requirements. Can y'all hear? Okay. Rent increase requests and requirements covered under the typical loan requirement section of the day's training. Term gross rents includes the cost of any utilities paid by the residents. And then for tax credit development, gross rent does not include rental assistance payments made on behalf of the tenant under the Section 8 program or similar programs. That is not the case with home funds or the National Housing Trust Fund, but that would be changing in January. And then rent limits are determined by the bedroom size. The calculation is based on the income limits, and you use 1.5 person per bedroom. But luckily, we have those listed in RCRS for you as well, so you don't have to worry about doing that calculation. Rents charged cannot exceed the agency approved if required, even if the rental amount equals the rent increase. So Yolanda owns and manages Thunder Mountain Apartments and wants to increase the rents. The agency approved a rent increase of $600 for a one bedroom and $750 for a two bedroom. Yolanda notices in RCRS that the rent limit for her community is $800 for a 1-bedroom, and then $950 for a 2-bedroom. Can she increase the rents above the $700 and the $850 without the agency approval, since the amounts do not exceed the rent limits? No, she can't do that. So even if you have a property that doesn't require agency approval for rents, you cannot raise those rents above the rent limits as well. Rent limits include the utility allowance for tenant pay utilities. Mandatory fees and services are not included in the rent. Are included in the rent. And then the maximum allowable rent calculation. So we have the tenant paid rent plus the allowance for utilities paid by the tenant. And then the mandatory fees equal your gross rent. So in this particular example, what is the gross rent? We have a 3-bedroom apartment with the 60% set aside, 5-member household, the $1,800 tenant rent, and $200 utility allowance. So what is the gross rent for this particular apartment? It's going to be $2,000, $1,800 plus the $200. Is the rent limit being met? In this particular example, it's a 2-bedroom apartment, 50% set aside, 3-member household, $800 in rents paid, 100 utility allowance. The gross rent is $900. So is it being met? Yes, it is, because the $900 is less than the $975. Everybody good with that? Reviewing rent reminders for tax credit developments. Gross rent does not include the rental assistance or Section 8 or similar programs. So in this example, 3-bedroom apartment, 80% set aside, 6-member household, $200 in tenant rent, $200 utility allowance, and a $1,500 Section 8 voucher. So what is the gross rent in this particular example? Right, it's going to be $400 because we don't consider the $1,500. Fees that are charged to residents. They have to be optional and not a condition of the lease. They have to be reasonable, available to market and low-income households. They have to be reasonable alternatives available. So you cannot charge fees for facilities included in the eligible basis. Required fees such as renter's insurance are allowed. However, the fee must be included with the rent and utility allowance to determine if the gross rent is acceptable. So if you have $500 in rent that you charge, the utility allowance is $100, and you have a mandatory fee of renter's insurance, $100 for the year, what is your total rent, gross rent for that particular property? Right, so it's going to be the $500, $100, and the $100, $700. If you're doing the rental insurance and it's a month calculation, remember you're going to apply it for the whole year as well. Everybody good with that? And then does your community, do any of you have properties that charge fees? You don't like them? Me either. My apartment complex that I stay at started offering the valet service, but it's mandatory for everybody. But I live near the dumpster. But so I don't use it that much, but I still have to pay for it. So allowable fees are non-mandatory fees for meals if you had a senior property. Late fees are acceptable. Pet fees are acceptable. If you have a property and you allow pets and you charge $50 a month for a pet and then an additional security deposit, that's fine. You can't charge for the use of the community room, but you can charge for cleaning the community room after it's been used or any damages that took place. And then application fees do not exceed the average cost out of pocket. So if you're charging a $100 application fee, but you only have to pay $25 for the screening through your software vendor or whoever, is that acceptable? No, because you're pocketing $75. That's not acceptable. So non-allowable fees are covered parking where the cost was included in the eligible basis, and there's no other place to park. Redecorating fees, transfer fees, wash and dryer hookup fees, separate fees charged for tenant facilities such as the pool, laundry rooms, garage, and the storage when the cost of these facilities is included in the eligible basis. So if these fees are charged, they should be listed on page 2, part 7 of the TIC under the rent section. So in this particular case, now we've added in fees. What is the gross rent? We have a 1-bedroom, 40% set aside, 2-member household, $750 in rent, $50 monthly renter's insurance, and then $100 in the utility allowance. So, right, it's going to be $900. That's $750, the $50, and the $100. Everybody good? Are you trying to figure out where that apartment is? I can tell you it's not in Durham. Is the rent limit being met with the added fee? So we're still at, the same 50% set aside, 1-bedroom, 1-member household, $600 in rent, $100 in renter's insurance, $100 in the utility allowance. The gross rent is $800. Are we meeting the rent limit in this particular example? No, because the $800 exceeds the $794. It only exceeds it by $6, but it's still over that rent limit. So what could you do in this case to make it meet the limit? That's correct. Shirley said lower the rent by $6 and you would be fine. And then Shannon said take the renter's insurance off and make them get their own. And then she has a fire, but that's what you have your insurance for. Yeah. How many of you work at properties that require renter's insurance as part of your requirements for them to live there? You don't see that often in affordable housing because people rather have the rent than that fee be deducted. Utility allowances is about to become really simple with the home requirements, but these are the requirements. All projects that participate in agency administered rental programs must update their utility allowances at least once annually, and you're going to do that in RCRS. Implementation can only occur after the agency has reviewed and approved. New properties, you do not have to submit a new utility allowance until after the property has reached 90% occupancy rate for 6 months or after the first year that the property placed in service. With each request, a utility allowance type must be uploaded in RCRS with a cover letter indicating the utility type, costs that are to obtain the utility allowance. So if you have to get a third party to do it for you, that's those costs are paid by the owner and cannot be passed on to the tenants. And then utility allowances include all the utilities paid directly by the resident. Owners, managements are allowed to utilize multiple methodologies when calculating the UA, except for rural development HUD properties. And you're allowed to switch methods year to year. Requests can be submitted anytime during the year. The required processing fee, if applicable, should be paid prior to submitting the utility allowance for review and approval. And then the process you approve utility within 30 days of the receipt of the information if it is submitted correctly. So we have 30 days to review it and to look at it. You can't bill the tenants for utilities based on the unit size, number of household members, or other general allocations where conservation efforts by the household do not reduce the bill. The owner can separately bill tenants for utilities if the units are sub-metered. We can only make a difference in the type of unit, garden versus townhouse. There is no option for difference based on square footage. When using the PHUA for the entire property, please make sure you're using the correct one. It must be effective within 90 days of the PHA making it effective. The management company is responsible for checking up on this. There are currently over 70 public housing authority UAs being used. If you are not obtaining the most current, your tenants may be overpaying their portion. And then know if your site pays the water and sewer, the tenants are paying for the water and sewer, and the utility studies do not reflect that. You have to tell the companies that are performing these studies for you. And then rent increases will not be approved without a current UA. And then failure to maintain an acceptable UA will result in non-compliance. And we catch this during the file audit process. There are 7 options. There's the rural development, rural housing. So you submit your rural development budget with the approved utility allowances. They send you back that cover letter with it listed. You upload that in RCRS, and that's all you have to do. It's the same thing with the HUD. If you have a HUD-based budget, you submit with your utility allowance, they send it back. If you have a HAP agreement, Quadell, normally here in North Carolina, will review that. And then they will send you back that approval letter, just like with rural development, and you'll upload that in RCRS. Then there's collecting the Public Housing Authority. The other ones are ones that you have to pay for. This is the utility company estimate, the agency estimate, the HUD utility schedule model, and then the energy consumption model. So normally in the past, 4 through 7, you really would have to, with the home program, you would use that because you couldn't use the Public Housing Authority. That's going to change in January. So there's going forward after January, when you're uploading these with an effective date of January the 1st, you can use your housing authority and you don't have to use these other ones because the home will allow you to use that the PHA. So that's going to make it easier on everybody and save their properties money as well by using the PHA. If you need information about our utility resources, what's required and different things, it's located on our forms page. You would click on where the forms are, and then owner management forms, and you see the utility allowance is highlighted there. That's going to be the policy, the sample utility allowance, effective dates, approved vendors that you're required to use, and then the instruction sheet for compliance, as well as the utility allowance agency estimate. And then Tammy Douglas is the one who reviews the utility allowance. So if you have any questions, you can reach out to her. And are there any questions on utilities, allowances, fees, and rents? We are good. All right. Who is next? Krista is joining us.
So disclaimer that information presented should not be interpreted as legal advice or legal authority. Fair housing issues are fact specific. Therefore, housing providers should seek legal advice from qualified fair housing professionals, attorneys regarding specific situations, policies, practices, procedures, and documents. This fair housing training section does not meet the QAP annual fair housing requirements. So we have our federal protected classes. And there was many laws that impact the fair housing. The types of dwellings that are covered. The FHA broadly applies to dwellings, which includes almost every residential rental unit. Single and multifamily housing, houses, apartments, and condos, group homes, shelters, migrant housing, assisted living housing, and long-term transient lodging. What are some of the fair housing fundamentals? Equality is that people should not be subjected to additional rules or requirements based on groups they belong to. Equity, people do not start from the same place, and we must acknowledge and make adjustments to imbalances. Integration, people are entitled to live and participate in the community. Choice, people can choose where to live. And individuality, respect unique needs and circumstances. The elderly definitions, state and federal elderly housing programs must use program definition elderly, typically 62 and older or disabled. 62 and older definition, every person residing at the property must be at least 62 or older. 55 and older definition, at least one person in 80% of the units must be at least 55 or older. The owner needs to define who can reside in the remaining 20% of the units. And you can also see the Housing for Older Persons Act of 1995 for additional guidance on the 55 and older definition. The disability definition is that it limits a physical or mental impairment that substantially one or more major life activities, having a history of such an impairment, being perceived as having such an impairment, whether the individual is or is not impaired, includes people associating or residing with a person with a disability. You must disclose a disability, and one of the above is present. Examples of disabilities are deafness, hearing loss, or other auditory impairments, cognitive disabilities, blindness or other visual impairments, mobility impairments, mental illness, or AIDS or HIV positive. Disability rights, housing providers are required to take steps and implement policies to allow individuals with disabilities an opportunity to live in the apartment community with reasonable accommodations and reasonable modifications. This is the law's way of leveling the playing field. Reasonable accommodations. The definitions are a change in the rules, policies, or procedures. They are necessary because of the individual's disability, provide full equal access to housing. When would be before tenancy or when applying for housing, during tenancy, or when facing eviction if a reasonable accommodation or source of income removes the basis of the eviction. Who can ask for it? A resident or family member, medical provider, social worker, or therapist, or anybody else that knows of the disability. Reasonable modification definition is a physical change in the premises to allow an individual with a disability to fully enjoy and use the dwelling. Reminder is that it includes common areas and interior of the dwelling unit. Property managers may request proof that the person has a disability and is covered under the law. Property managers may also request additional information that the accommodation or modification is necessary or will address the issue. DHHS targeting applicants or tenants can request further inquiry into the nature and type of disability, however, must be limited to matters directly related to the requested accommodation or modification. Rental assistance must be taken into consideration when evaluating the ability to pay rent and requests for reasonable accommodations to the standard credit history criteria. You must follow your tenant selection plan. A blanket rule, either stated or in a pattern or practice, that we do not provide accommodations for a criminal history may be illegal. Timeliness in responding to reasonable accommodations or reasonable modifications is important. Undue delay in responding to the request could be seen as a refusal to make an accommodation or allow a modification and consequently a violation of the law. Delays should be communicated. The last thing that you want is for somebody to come and ask you for a accommodation or modification and you don't get back to them and they automatically assume that the answer is no and they go hire an attorney. So make sure that you are communicating with the tenant and letting them know that you're working on it and that they haven't automatically been told no. If a tenant submits a reasonable accommodation request in response to a lease termination or eviction notice, the termination process should not continue until a decision on the request has been made and communicated to the tenant. Language access plan, that LAP, federal fund recipients must ensure meaningful access by persons with limited LEP. North Carolina Housing Finance Agency requires all recipients to complete a 4-factor analysis, and you can find a copy of our guidance at the end of your training book under resources. The LEP, the limited English proficiency, after deciding what language assistance services are appropriate, develop a plan to address needs of the LEP population served. Elements to consider are who needs assistance and what language assistance is needed. Identify the points of contact staff may have with LEP persons. Identify ways language assistance will be provided. Provide appropriate translated notices to LEP persons. Examples would be eviction notices, emergency plans, and provide interpreters for meetings. It is the owner management responsibility to provide forms in the necessary language. The agency or management alternative forms, so it's the owner management responsibility. Reauthorization was signed into law on March 11th, 2022 for the Violence Against Women's Act. Effective changes began January 1, 2024. Violence Against Women's Act 2022 includes provisions that affect housing providers. In 2004, HUD Section 8 and public housing programs were involved. With the 2013 reauthorization, more HUD programs, including home funds, rural development, and LIHTC programs were covered. This latest authorization notably adds the National Housing Trust Fund program. These include the 53, 80, 81, 82, and 83, and previous versions, including translated versions, have been removed. Violence Against Women's Act updates have non-retaliation provisions and non-coercion provisions and protections to report crimes from the home. Landlords, homeowners, tenants, residents, occupants, and guests of and applicants for housing shall have the right to seek law enforcement or emergency assistance on their behalf or on behalf of another person in need of assistance, and they shall not be penalized. The HUD Form 5381 is the emergency transfer plan that must be posted in all of your offices. Make sure that it is posted so that a resident or an applicant can actually get to it. If you don't want them climbing across the desk behind you to get to it, don't have it back there. Have it where they can walk up and they don't have to ask you for it. They can access it and read it on their own time. There's multiple fair housing trainings out there for everybody to take advantage of. We offer fair housing training virtually at no cost. Don't forget your local apartment associations. Make sure that you have a good fair housing attorney, because a lot of times you need to reach out to them about the specific situation that you have going on. And remember that everything's always changing. Affirmative marketing is properties financed by North Carolina Housing Finance are prohibited from denying occupancy to a household because the household participates in Section 8 program, requiring a minimum income that would effectively prevent a voucher holder from qualifying for housing. Properties financed by us must state in their leasing criteria that the property will comply with state and federal fair housing laws, identify methods to market to persons with disabilities and populations least likely to apply screening criteria uniformly, display an approved affirmative fair housing marketing plan in the leasing office and make it available to the public upon request. Again, not behind your site manager where someone's crawling across the desk. To obtain agency approval, upload it in RCRS. Make sure that you have your checklist attached to it. We will review that during the review processes. Effective January 1, 2022, failure to have an approved plan in RCRS and posted in the office will result in project noncompliance. Make sure that you are logging into RCRS and finding the most current approved version, and that is actually the version that's on the wall in your office. Make sure it's not expired as well. So you're going to identify populations least likely to apply, ensure the population is actually represented in the surrounding community, implement marketing efforts to attract target populations. Efforts should be made to publicize through the type of media customarily used by the target applicant. Maintain documentation evidencing outreach. They might be flyers, mailings, advertising, community contact letters. So the affirmative fair housing marketing plan is 5 pages, pages 1 through 5, plus your instructions, plus your 4 worksheets, equals 472 pages total by the time you're finished. Plans that have been approved by another regulatory agency may be submitted. You must upload the complete approved affirmative fair housing marketing plan, including the worksheets and supporting documents, so that you can find the checklist on our agency website. And if you have any troubles with it, you can reach out to Miss Dorian. Make sure that it is not 5 years old from the signature date. When it expires, you have 2 options. You can create a new one and submit it for approval, or if there's no changes, you can submit an updated plan, date, sign the plan listing no changes or updates, and include a cover letter that states no changes or updates. And just remember, if you have a change in ownership or management agent, it does require a new form. Some common reasons that they are sent back are all pages and worksheets are not completed, that you've left nothing blank. Make sure that there is no documentation missing. Make sure it's not expired. Make sure it's not outdated as far as the ownership and management. And make sure you've signed and dated it, and that it's the correct form. And that it's the correct one is posted in RCRS and at the property. Yes. The question is, if you have a blended property, can you use the same one that you use for HUD? You can. You just need to make sure that you have the checklist and that you've uploaded it to make sure, because there may be some things that we want changed. So you still want to make sure you check that checklist, upload it submit it for review and approval. And then they'll notify you if there's anything that is missing that we need to see. So the tenant selection plan, Miss Heidi on our team, she reviews and approves those. The agency requires landlords who participate in agency-administered rental programs to have a written property-specific tenant selection plan. The criteria contained in a tenant selection plan must not be so restricted that it creates a disparate impact on groups protected by the Federal Fair Housing Act. The criteria must align with HUD's requirement for housing entities to affirmatively further fair housing and conform to any applicable HUD guidance published on the subject. Requirements are that all agency monitored properties, regardless of HUD or RD participation properties, TSP must specify how applicants are selected for tenancy. All criteria used in the decision-making process must be included, must have enough specificity applicants can read it and reasonably determine their likelihood of acceptance or denial. Contain screening criteria that is no more restrictive than described in the policy. Be clearly posted in the property rental office as well as anywhere else applications are distributed, including websites, and copies must be available to applicants upon request. How many people have actually read your tenant selection plan? Okay. A lot of times the site will get it from management. The management will send them a little note and make sure this is posted on your bulletin board. They print it off, they post it on the bulletin board. They have no idea what it says. Make sure they're reading it so that they know. The agency's responsibility to affirmatively further fair housing within our housing programs. Among the agency's public policy objectives relate to fair housing are the following: ensure access to housing created through our programs by vulnerable, underserved, and at-risk populations through the application of reasonable tenant selection criteria by our landlord partners. Ensure access for vulnerable, underserved, and at-risk populations in the most integrated settings within the community. Ensure compliance with all applicable federal regulations related to fair housing. The TSP compliance requirement, failure to comply with either of these requirements or failure to satisfactorily address concerns or deficiencies identified by the agency may result in the property owner and or agent being considered not in good standing and result in a suspension from doing further business with the agency until the issue is corrected. What is your role? So the checklist is on our agency website. And make sure if you submit a plan, whether it's the TSP or the Affirmative Fair Housing Marketing Plan, and it's returned to you because you forgot to upload the checklist with it, when you resubmit it, you have to have the checklist and all of the supporting documents. Some people, sometimes they think we still have that one piece and they just upload the checklist and then we don't have everything we need. So common TSP issues resulting in a return plan is not following the agency policy, not meeting the criminal criteria, not submitting the checklist when submitting a TSP, not including the correct set-asides and number of units for each set-aside available, not including all applicable student rules, that would be for a tax credit, home, HUD, and RD, not including the DHHS targeting program verbiage. Do not ignore the RCRS generated email indicating the plan was returned. Do not resubmit the plan without making corrections noted in the returned email. If you need help with the TSP, you're going to reach out to Ms. Heidi Holt. Does anybody have any questions? Yes. The question is, with all of the changes in the government, are we foreseeing a change in the Affirmative Fair Housing Marketing Plan? The agency is going to continue to have a Affirmative Fair Housing Marketing Plan. So at this time, I don't think that we're anticipating any changes, are we? No, no changes. Okay. We're going to take a 15-minute break.
All right, friends. Are we ready? Stephen, go back to your seat. Well, then just have a seat right there so you're not blocking their view. All right, before we start, this is the last session, the last section. So bear with me. I got the last section both days. Bear with me. We're going to go through. We'll answer any questions before we start. Krista, are we good in virtual world? We're good? Perfect. All right, we're going to talk about tips for award-winning compliance. I didn't realize Susan was also over here interrupting the class, or I would have called her out as well. So, okay, so we're going to talk about tips for award-winning compliance and regulatory compliance. So monitoring frequency. For file reviews, it is determined, well, files and physicals, it is determined by funding source. For file reviews, if it is straight tax credit with no other funding, we're going to come out, well, we're going to do your files and your physicals every 3 years. If you are have an RPP loan, we are going to come out annually. If you are average income, even if you have no other funding, we are coming out annually. And if you have a state tax credit or the workforce housing loan program, we are going to come out annually. So the only time you're going to see us do your files every 3 years is if you are straight tax credit, not average income. Okay. For physicals, for tax credit only, we are going to come out every 3 years, but we are going to do 20% of your units. If you are straight tax credit and you have a property that has over 100 units, we will actually still do your physical inspection every year and not every 3 years, because we really don't want to do 20% of your units every 3 years. We have some properties in our portfolio that are 400 units that are straight tax credit. We are really not trying to do 80 units every 3 years. So we come out and do 10% every year versus that every 3-year cycle. So if you have 100 or more units, despite your funding, we're still coming out every year. If you have an RPP loan or average income, we are coming out every year and we're going to do 10%. Same with the state tax credit and the workforce housing loan program. With rough scheduling, as mentioned earlier, our compliance monitors get their portfolio in December every year. We work in December trying to plan out our next year. In January, everybody puts in their rough schedule, and it is just that. It is a rough schedule. We are taking our entire portfolio and figuring out what areas we're going to be when, what's going to work with our schedule, how we're going to fit in file reviews and physical inspections and other focus areas that we might have to do. So in January, we have a rough estimate of when we're coming to the properties and when we're going to do file reviews. So you will see in our CRS a month and the year of when we are going to potentially come. We ask that you check often because things change and we will move them if something comes up or we couldn't get to a certain area at a certain time and we've had to reschedule some things. If you in January see, two different properties that are very, very close by that have the same manager scheduled 6 months apart with two different inspectors, January is the time that you reach out and say, hey, I would really like them to be done at the same time. And we can try to move things around to accommodate that. Our staff, we put the rough schedule out in January. Our staff will email prior to a physical inspection 30 to 60 days in advance. And then the notification letter will be released in our CRS 14 days in advance. But they give you ample time via email, anywhere from 30 to 60 days in advance of that physical inspection. Again, if you contact the monitor, if you have a physical inspection schedule request for the month of the rough schedule, we will consider rescheduling if the request is at least 2 months in advance. Again, we have to move around sometimes our entire portfolio to accommodate. So sometimes we literally can't or don't have time. And the later in the year, the harder it becomes because we have so much to get done in one time. That home tab in our CRS, as soon as you log in, you've got the announcements, and then you would just click the monitoring home to be able to see the compliance monitor, every property that is in your login that is going to be reviewed or visited that month or that year with the rough schedule that's there. The release of the notification letter, again, it gets released from our CRS 15 days prior, but you have already gotten the email confirmation that we are coming. In that notification letter, it includes a tips for a successful property inspection, and it includes our state non-compliance items. For a file review, you receive the 14-day notice through our CRS. You don't get an advanced warning that we're going to do it. Your advanced warning is the rough schedule. So if we say that we're going to roughly audit your files in July, that is your advance notice other than the 14-day notice. Ensure that everything is requested, ensure that everything that is requested is provided. And you have those 14 days to do a self-audit on your files, to review, to make sure that you actually did upload the lease for every unit when you had that 30-day window after move-in. That 14-day window is there for you to make sure that all of the documents were signed, that they were scanned appropriately, that you're not missing anything. It amazes me how many people get that notice and say, oh, I already uploaded the documents. Click submit the same day we requested them, and don't self-audit. Use that 14 days to self-audit your work before you confirm that the files are there. Just a reminder again, make sure that the roles and the tags are updated in our CRS, because this file review and physical inspection notification letter go to the person that's tagged. And so if you don't have anybody tagged as a file review person, nobody's going to get notified that there is a file review out there, which means you might get the no response letter because nobody knew that it was there. So make sure those roles are updated. To be in compliance for file reviews and physical inspections, units must be occupied by certified income eligible household at restricted rents. They must be rented to non-transient household, meaning that initial lease has to be a minimum of 6 months on a tax credit property. Maintain a condition state suitable for occupancy and meet program inspection protocols. The project must meet the minimum set-asides and be available to the general public. Preparing for file reviews. They are conducted through our CRS. Review the notification letter to make sure you know what we're asking for. Ensure that the utility allowance has been updated. This is probably one of the top findings that should not be a finding, because you're supposed to update the UA every year, and we write it up entirely too much that is expired. Ensure that the management forms are uploaded and current. These are your affirmative fair housing marketing plan, your tenant selection plan, the 8609s, any of those required documentation, make sure that they're updated. Only provide what's on the notification letter. HOTMA, we have talked about. It went into effect July 1st for all properties. The only exception are those blended with the HUD rental assistance, the multifamily properties. Those you're allowed to wait till January 1st, 2026. We will not be extending that at this point. So at any of your, on tax credit properties, any of your certifications at this point, you should be HOTMA compliant. Okay. RCRS, we rolled out, okay, hold on one second. Krista has a question.
What documents should be uploaded in RCRS when the file request was for a transfer household? The policy we have in place, dependent on 8B on 8609, only requires transfer request form, transfer tick, student form, VAWA addendum, and lead-based paint disclosure if applicable.
So if we have requested a file that was a transfer, we still want the move-in and the original recertification. We're actually not looking for transfer documentation. If you have transferred a household and listed it as a move-in when it should have been a transfer, that is a different issue, and you have cited something wrong in RCRS if it was a move-in and should have been treated as a transfer. But a transfer in RCRS should say transfer, and we will still look for the original move-in document for documentation that qualified the household, not the documentation that moved them into that unit. So again, if you have a transfer and we have requested unit 101 and their original unit was unit 304, we want the original documentation from unit 304 that qualified them as a low-income household. And then we want the most recent annual recertification or update, because obviously their move-in was several years prior. They've transferred somewhere in the middle. So we want the move-in from 2015 when they moved into 304, and then we want the most recent 2025 annual recert. If it was a transfer that you incorrectly coded as a move-in in RCRS, that is a whole different scenario, and it's considered non-compliance because you didn't cite it correctly, but we would work with you to figure out what was happening. Hopefully that clarifies that question, Krista. RCRS, we rolled out NAMA 8 at the beginning of the year. This is for properties that have a third-party software system that create a file that you can upload all of your data into RCRS without going into each individual unit and creating each individual unit event. Currently, our software supports NAMA version 6, 7, and 8. But as of December 31st, we will no longer support 6 and 7, and we will only accept NAMA 8. NAMA 8 is the version that has all of the HOTMA information in it. And if for some reason you have that blended property that you're not using HOTMA until January, NAMA 8 still allows you to click the button that says you're not HOTMA compliant. So you can use NAMA 8 even if you're not following the HOTMA rules. So again, as of December 31st, make a note in your book, because your book, this decision just came out after the books were printed. The books were printed and it only says version 6 is going to be expired, but it is in fact 6 and 7 that will expire December 31st. By a show of hands, if anybody knows, is anybody in the room still using 6? 7? Or is everybody that's using a third-party software, are you already on 8? Or at least getting there? Okay. We have a virtual question.
First year lease up. All documents are uploaded. Are we required to upload the first recertification file or just the data?
A first-year lease-up. All move-ins, you're going to upload the move-in documentation. If it is a first-year recert, you are not uploading any of the recertification documentation unless we request that file in a file review, and then you will upload the recertification documentation. So all move-ins, yes to documentation. The recertification, you're not going to upload the documents. You're only going to enter the event data, not the documents that are attached. Unless we request the file for a file review, then you will update or upload the recert documentation. If you have any glitches or any concerns with submitting using the NAMA 8, reach out to compliance help so we can figure out if there are any other glitches. But it has been working pretty seamlessly for the last couple of months. So hopefully we've worked out all of the glitches that there were at the beginning of the year. Our 2025 adjusted inflation values are listed in the book. 2026, we do have the announcements of what those adjustments will be for 2026. The passbook rate remains the same. The COLA increase is 2.8. That just came out. The elderly disabled deduction, which does not apply to tax credit, is $550. Adoption assistance payments, the full-time student dependent income, the dependent deduction is $500. The asset threshold is $52,787. And the asset limitation, which again doesn't apply to tax credits, is $105,574. With adding unit events, if you are doing them manually and not using a software to do it, at move-in and recertification, the unit events, you need to indicate if you are implementing the HOTMA rules. There is a little drop-down box that says yes or no to whether or not you're using HOTMA. Yes, ma'am. It's January 1st. Those are the 2026. The question for TV Land, because I forgot to repeat it. The question was that 52,787, whether that was going into effect July or January, and that is a January 1st, 2026 threshold for HOTMA. Yes, virtual.
If you are doing a self-cert for a household, how can you complete the unit event without entering income and asset information?
If you are doing a self-cert, they are still self-certifying what their income and asset information is. And so you would put the information for a certification if they're doing self-cert. If they are doing an update and it is a property that doesn't have to do a full recertification, you're going to select update instead of certification in RCRS. Is that what they're asking? If it was not a full recert? If that doesn't answer your question, please clarify. But if you are doing a property, tax credit property only that doesn't have to do full annual research after the first year, then your yearly will be considered an update and not a certification because you're not certifying anything. With the NAMA changes, we do need a little bit of help. When a household has an asset with a zero balance or a negative balance, because we consider that a zero balance as well, if there is a zero balance, please don't enter it in RCRS. I believe that it actually doesn't take them now. There was a moment where you guys could enter them, but then they made an error on our side. But we don't want the assets with zero in the system. It causes a glitch, and then we have to do some funky things. So just help us out with that. Entering assets into RCRS, there is a new list of asset types. So you're going to select the asset type and the asset status. If the asset is zero, again, don't enter it into RCRS. That asset status is whether it's a current or a divested asset. Entering income into RCRS, again, you're going to select the income type. Both with the income and assets with the HOTMA rules, you're going to see a whole lot more options than you did in the past. We do have HOTMA 6.0. It is the exact same as HOTMA 5.0. The only difference is the note at the top and a spelling error. But the note at the top that just says that there are that blended properties with HUD rental assistance must implement HOTMA for all certifications effective 1/1/2026. That is the only difference between 5.0 and 6.0. There will be a 7.0 changing the rules for home, but that is really the only difference. Where on 6.0, we have said home do this differently. Obviously, we will have to edit that with the new home final rule. So our most common file review non-compliance. Our CRS does not match the signed and uploaded tick. So you have entered some information into our CRS that is not on the tick. Your data entry is incorrect. Whether it's the tenant information, your most common is your rent and your subsidy. Those are the biggest differences. The move-in date entered in RCRS does not match the documents. This happens a lot when you have management companies that utilize RCRS for the tenant stuff versus a third-party software. So they've entered a bunch of stuff into the system, and then something happens and that tenant doesn't move in for a couple of days, and they never go back and change the information. All requested documents are not uploaded for the file review. Whether it's the lease addendums, not all of the pages of the lease, not uploading the recertification documentation. Again, we cannot stress enough, please check your scans. Please. We see a lot where they're labeled wrong as well. So you might look at the document type on the screen and it says that the lease is there, but you never opened it to see that that wasn't actually a lease that was attached. So you do a lot by checking behind yourself. Missing unit events, the recertifications and the updates, those are big. You need to get in there every 30, to update within 30 days so that we have that information. Utility allowance is not being updated annually. Again, uploading documents that are not properly scanned. Not verifying income and assets correctly. And not using our required forms and not completing them entirely or completely. And even if you are using a form that is your own, that is not one of our required forms, if your form asks for something that we don't require and you don't fill it out, it's still non-compliance. We see a lot of management companies that create their own forms, and one of the biggest culprits is having to have it notarized. Well, if you don't get it notarized, we don't require them to be notarized, but if you don't get it notarized, it's non-compliance because it's not a completed form. So if you're asking for more information than we want and you don't complete that form, it's still non-compliance. Not having all household members 18 or older sign the TIC. It's not a requirement for them to sign the lease. That is a management decision, but everybody 18 or older is required to sign the TIC. Read the notification letter, only provide what we ask for. Use clarification statements as needed. We would much rather see a couple of clarification statements in there telling us why you did what you did, or why you didn't do what you were supposed to do. Income and asset worksheets are key. It shows us what you did and how you got to the numbers that you got to. Make sure you update for HOTMA changes. If you have questions, email the compliance monitor that's conducting the review. In that 14-day time period, we've already talked self-audit, 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 self-audit. Everybody got a flip guide today. You got one yesterday if you came yesterday. The elephant in the room when it comes to Inspire. An owner agent may have to incur cost to bring a property into Inspire compliance. There's no dedicated funds from HUD or HFAs to make necessary repairs or upgrades. It is possible to use replacement reserves or project cash flow. Talk to the investors, lenders, other parties. Lack of funding is not an excuse for non-compliance. For physical inspections, we are, yes, Krista.
How can the virtual students get a flip guide?
The virtual students can get a flip guide by coming in person or ordering them. Yes, Stephen. On the flip guide page of the book, there is a QR code or the website where you can order them. But that is one of the nice added bonuses along with the fun Post-it notes that you get as a prize coming into the room, listening to us talk. So we are conducting to make sure that the properties and the units are in compliance with Inspire, with IRS, and with our state non-compliance items. Tips for compliance, have a preventative maintenance schedule. Don't wait until you find out about the inspection to work on the property. Walk your property on a regular basis. I know we touched base on that a little bit yesterday. Tell you a story. I went to a site. The manager had been the manager there for 2 years. First time I had ever been to the site, so it was older. First time I had been there, so fresh eyes. You're looking around all the buildings. I said, "Oh, what is that over there?" It's a fenced-in area. She goes, "Oh, I don't know. It's a dog park." It's been her property the entire time she's been there. She had no clue. Who do you think wasn't walking around the buildings? Because it wasn't hidden. It was in between 2 buildings, but it was a dog park. So walk your buildings. Conduct random inspections. When staff is inside of apartments, look for other work orders. When I was a regional, I used to tell my maintenance men, you should be creating way more work orders than I'm giving you. Because when you're in there, you should be finding the other things that need to be fixed, not just fixing the one thing that I sent you in there to fix. Budget properly for replacements and big repairs. Don't wait. It might only cost $5,000 to seal and restripe a parking lot. But if you put that off for 15 years, it's going to cost you $100,000 to rip up the entire parking lot and redo it. So that couple $1,000 year 1 is going to cost you a whole lot more in year 15. Notify staff on site of the rough schedule that's in RCRS. Some management companies, their site staff doesn't have access to RCRS. So they have no idea what the rough schedule is or when somebody's coming. So if your site staff doesn't know, and I don't know of a single maintenance man that has RCRS access. So make sure that everybody on site knows what that rough schedule is so that they are already mentally preparing for that July inspection in January as well. And as soon as the inspection date is confirmed, again, notify everybody. Reminders for inspection day. For all properties, making sure that affirmative for housing marketing plan is posted and accessible. Making sure that the tenant selection plan is posted and accessible. Making sure that the emergency transfer plan is posted and accessible. And you no longer have to do the management plan. If you have a Chodo property, then you need to also have a copy of the tenant grievance procedures posted and accessible in the common area. And again, on a bulletin board behind your head in your office, behind your desk is not accessible. Again, day of inspection, reminders for your building inspections, making sure that you are reviewing your annual inspections that need to happen, elevators, sprinklers, fire alarms, backflow, backup generators, the rechargeable fire extinguishers, making sure you're having copies of those inspections available for the day of the inspection, prepping months in advance to make sure that they are not going to expire when we come, but also reviewing those reports, because if there are deficiencies on the report, you have to provide proof that those deficiencies were cured or it is a non-compliance. Choosing the units to be inspected, we have a sample size based on the funding type and the compliance period, which we talked about earlier. Our vacant units, we are going to go into 20% of those that I don't see that changing for 2026, but it could change in future years. We may inspect additional vacant or occupied units as deemed necessary up to 100%. And I have done a 100% unit inspection in the past. It's not fun for anybody. Units that will not be chosen. Typically, our staff doesn't want to go into bed bug or other pest infested apartments. Our inspectors will ask you ahead of time for all of these, for you to give us the units before we pick our units. If you wait to tell us, oh, that unit has such and such, after we've already given you the list, guess what? We're going. You got to be upfront at the beginning when we ask you the questions of which units have bed bugs, which units are under eviction, which units are in a court-related lockout, you've already filed the writ, which units have a contagious illness. I will even say the ones that maybe not contagious, but have a terminal illness. We're not trying to make somebody's worst day. Vicious or barking dogs, obviously that one you may not know until you get to the door, and that's okay. Or your residents that are verbally or physically abusive, we can also add to the list that we won't know until you get to the unit are the minors that are home alone. We won't go in those units. But if we have given you, we're going to go in these 10 units and we see that look on your face that we said a unit that you didn't want us to say, and now you've said, oh, that unit has bed bugs. I'm going to take my chances because you didn't tell me that ahead of time. So make sure that you're being upfront and honest when we ask you those questions. Vacant units over 6 months, we are going to go in them whether they are rent ready or not. And it is non-compliance for vacant units that are over 6 months. Our Inspire stuff, we're not going to go over in detail. It has not changed. It was last updated January of this year. And the only thing that changed were our grace period items of what was, none of the criteria has changed. The only change in January was moving some items to no longer be a grace period. It will obviously be a 4.0 for January 2026 because there will be 0 grace period items in 2026. This is the state noncompliance and the tips for a successful inspection are on all of the notification letters. Again, make sure you're sharing that with your site staff. Maintenance and managers need to have copies of those. This is how they prepare for the inspections. These are in 2024. So I can't wait to see what next year's are. I did pull some numbers for the housing conference. If anybody was there, you get to hear some of them then. But 2024, our biggest non-compliance for Inspire was the GFIs in an unprotected area. And those are still a grace period item this year. They will not be next year. So you should have at least by now fixed all of those. The next item was that TPR relief valve, which was again a grace period item last year, and it wasn't this year. Outside of those, the smoke alarms and the blocked call for aid systems are some of the biggest culprits of findings. For our state items, egresses are one of the biggest items. But I think the one that blows me away the most is the number 2. It is 346 units that have been vacant in 2024. Vacant over 6 months. And every time I see the number, it's even higher in 2025. It just blows my mind that there are that many units that have been vacant for that long. Vacant units not ready, not rent ready. And as you can see, reporting to the RCRS, this is not your documents. This is you even telling me that you had to move in or a move out. So that is our number 4 state noncompliance, is not reporting to RCRS. So tips for an inspection. Again, have a preventative maintenance schedule. Walk your property. Random inspections. Look for more things when you're in there. Budget. Deferred maintenance. Notify everybody of the rough schedule. And as soon as the inspection comes. Your report that comes after our inspection, it's pretty easy to follow. It does let you know if there's anything that is a 24-hour correction. Again, you're not going to give us the information in 24 hours. You're going to hold that information and upload it with the rest of your response, but we will be looking to make sure that you corrected it within the 24 hours. And in our CRS, it also shows the 24-hour notice. And I don't know if you guys have all been in our CRS, but it also shows the pictures now of the findings, which is a really cool tool, because in years past, on the management side, you weren't able to see the pictures of those findings. And so to be able to click on the pictures now is really nice. Reviews, the results letters. Again, that results letter notifies owners and management of all the findings and if corrective action is required. Management is going to upload those responses in a PDF into our CRS within the time frame. One document. If you have 1 noncompliance or 50 noncompliance, you may only upload 1 file. So all of your work orders, all of your documentation have to be scanned into 1 document and uploaded 1 time. The only time you can upload multiple documents as a response is the compliance resolution packets. If you have a letter that only has comments and concerns, you don't have a response. And when you're doing any of your responses, you do not have to respond to the comments or concerns. Those concerns and comments at the bottom of the letter are just that. They're just things that we have noted that you might want to take a look at before they become non-compliance. So in our CRS, if you see a non-compliance in red, you are in the IRS compliance period. If you see them in orange, you're in the extended use period. Any items that are yellow are comments or observations. Or green, you'll see green ones as well. So the orange, again, is extended use. The grace period is going away, but that is in there, and pictures are now available in our CRS. If you click on it, it pulls it up bigger so that you don't have to squint and see what is on the little itty bitty screen. For a file review, again, we don't want a copy of the results letter. Believe it or not, we sent it to you. We have a copy of it. We don't need another one. Ensure to include what is asked for. Don't backdate the corrections. Don't use the statement true and correct as of. You do not have to respond to comments and concerns. If you don't understand a finding and you need more information, reach out to the compliance monitor that conducted the review. We are happy to explain what we found and why we wrote it up. So for physical inspections, when you're responding, provide a work order, invoice along with pictures documenting the correction. Don't send pictures for everything. Only send pictures for the things that we ask for pictures for. That is one of the biggest things that make the files entirely too large to upload into our CRS, is when you're submitting so much documentation. But on the work orders, make sure that they are dated and signed and completed, and they say what you did. Send an invoice if you had to hire somebody to do it, because you're not going to have a work order for it. You're going to have an invoice. Send a work order if the staff completes it. Send a picture if it's something that you had to have a tenant do, like move a bed from in front of the window. And please, again, only send what is requested. A bid or a proposal is not a resolution to a non-compliance. It will remain uncorrected until you submit documentation that it was actually corrected. So you telling us that you got a bid to do something that's going to be scheduled 3 months from now, that item will remain opened until 3 months from now, until you send us the documentation that it was fixed. The final report letter, you get a compliance results letter, you read it, you get all of your work orders together, you submit those, we review that documentation, we correct everything that needs to be corrected, and then we send you a final report. That final report will have a date or the word no finding if it is corrected. A no finding item would be if you forgot to upload something and it is clear as day that that was received prior to, it was just something that was missed, then we would clear, it would be a no finding, or your grace period items were listed as no finding. If you get a final report that says uncorrected, you will have to submit a compliance resolution packet in order to correct that. Until December 31st, you have a grace period of 15 days after this final report to respond for us to correct some items. January 1st, that grace period goes away. The final report is the final report. The inspection or the file review will be considered closed, and we can then send the 8823, if there is one, to the IRS the next day. And anything open, you will have to submit a compliance resolution packet. So this goes back to please audit your work. Compliance resolution packets. Outstanding compliance will not show up in that little lovely red bubble. It is your responsibility to keep up with the letters and what is outstanding. There is no way for the system to tell you what is outstanding. Now, if you go into the system and you go into a property under compliance resolution packets and you hit the green button that says create a new compliance resolution packet, and you go to pull down the pull down box and it gives you that nice circle with a no, that means you don't have any open items. So you don't necessarily have to go and pull every year of stuff. If you attempt to create a compliance resolution packet and you get the big red no sign, that means there is nothing open for you to respond to. Only open non-compliance are there for you to be able to actually create a compliance resolution packet. There are instructional videos on our YouTube channel. When you're submitting any response, don't forget to click the action button or the submit button at the end of all of it. And that goes with everything in RCRS. We get emails all the time with, it's been 6 months since blah, blah, blah. Well, you never hit submit, so we didn't know that it was there. The grace period again is ending. Reminders, registration for classes, for the training classes close 2 Thursdays before the training. There is only one more Compliance 101 and Advanced Compliance training for the year. Our 2026 schedule is coming out soon. So be on the lookout for that and go ahead and put them on your calendars. And if you come in person, you might get a prize. There are no more key and targeting assistance trainings. They have been done for the remainder of the year. Again, 2026 is coming soon. The compliance manual is out. It will be updated for January, but it does include HOTMA updates, Inspire updates. All of our forms have been updated. There have been a couple of new forms that have been recently updated, but it will say when they were updated last. And again, they're living documents. So as we find things and as new regulations come out, we will continuously select those. Is there a question in virtual world?
I found a hidden box.
You found a hidden box.
Yes, so there's a couple of these questions that are a little bit old, but we may want to address them just so that they're
Okay.
clear. So to clarify, if an employee receives a 20% discount on their unit as part of their employee
Way over.
compensation package, would the amount of the 20% discount be counted as income?
That money is not going in their pocket. It is not income.
Next question. If the inspector asks for an invoice instead of a picture for the tenant corrections, is that okay?
A tenant correction. I'm not sure I follow why. So let me say this. The system automatically tells us for every finding to like the default verbiage as a corrective action is to submit a work order or an invoice. And we are all human, and sometimes we do not change the verbiage to be a picture. It happens. We do so many of these, and some of these inspections have a lot of findings, y'all. And so the default verbiage is a work order and an invoice because that is 90+% of the findings. And so if you know that it is a tenant issue and the tenant needed to move the bed from in front of the window, clearly we do not want you to hire a contractor for that, and we do not need an invoice for that. Sending a picture or even a work order that says maintenance went in and checked and the bed was moved. I have seen that as well. You can take that. It is solely because we did not change the drop down. We are not asking you to actually send an invoice or for that, a tenant thing. Just provide a picture.
And then this is not really a question, but a comment. We seem to have a lot of turnover at some properties, and it is hard to have a site manager contact in RCRS, and the regional would be that contact.
As long as there is a contact in RCRS that is reachable, especially on the day of inspection, that is fine.
Okay. To clarify, for Social Security, are we still required to stamp date received if the letter is not within 120 days?
So with Social Security, if it is their annual award letter and they get regular Social Security, you do not have to date stamp it because we will use the annual letter that was received at the end of the year for the next year. If it is anything other than SSA, so if you're getting disability, or anything else that may fluctuate, then yes, you have to date stamp when you receive that letter so that we make sure that it is within that 120 days, because those amounts change. Your regular Social Security that you draw because you have reached a certain age does not change except for with COLA. So that same amount on the letter that they got in December is the same amount on the letter that they're going to get the next November. That number doesn't change outside of the COLA increase. So you don't have to date stamp those letters, but the SSI letters that can change, those have to be date stamped.
Extended use property, post inspection. All issues have been resolved except for a unit vacant longer than 6 months. The physical inspection still states pending issue resolution. Are we required to report when the units are occupied, and how do we do so?
So if in our CRS, it still states that it's pending issue resolution, that just means the final report hasn't been released yet. We're still in the grace period. We're still in that period where that final letter hasn't been done. Once the final letter has been done, it will say complete. But if you still have an open non-compliance, yes, you have to tell us that it has been corrected. We are not going to go into our CRS regularly to see if you had to move in. If you have an item that was corrected and you don't have the option for a compliance resolution packet yet because it is still pending, you can reach out to your compliance monitor and see if it's too late to submit the documentation, and get the letter corrected before it's released. And I think there was a question on the back row. Yes, we are. So the question has to do with Social Security award letters and the government shutdown and access to those award letters. You must not have been here yesterday. As of right now, there is no other direction. They can call the phone number and get them mailed. That phone number is still active and working. You can offer help to them getting online or have family to help getting them online, because the online verifications are still working. You can still print them from online. The struggle is because of the verifications to get online. And that is the struggle. And that's where you might have to get creative in either assisting them or having family assist them. The technological struggle is the struggle. The verifications are still very accessible. And you can even create new Social Security online accounts that you have not. Like if you have never created an online account, you can still create an account and get your verification letter in the same day. The hard part, again, is having to have a smartphone to take a picture of your license to verify who you are. There are some local Social Security offices that are still printing letters and still open to be able to print those letters. So we as an agency have not allowed anything other than what has always been, because at this point, everything is still available. It may be more difficult to get it, and we understand that, but everything is still available. Any other questions before we finish this last part? Krista, is your secret hidden box good? Yes, ma'am. So the question is, if they, for some reason, don't have a smartphone and can't get online, it depends on when your certification, what you're trying to do, because for regular Social Security, you can use last year's letter until the new year's have been released. Right. So right now, you're still good to use the award letters that were mailed for 2025. So obvious, yeah. So, but the new letters, they're coming out usually mid-November. And so you'll get new letters. So right now you're still able to use the 2025 and apply COLA. The biggest issue are your properties that don't have regular Social Security, that you have to have those new letters. Uh-huh. And so right now we are not at a point where we are allowing any leeway.
When adding a new family member to an initial qualification, it was stated to process an interim. Are we processing an interim for tax credit? And does this apply to the home rule?
Okay. Well, we did not state that you have to do an interim to add a family member. That was talked about when we talked about the initial certifications. In tax credit, you do not have to do an interim certification. You're just going to add that household member to the next recertification. Any more questions in virtual land? Perfect. So we talked about the compliance manual. It is available on our website. We also have on there the advanced compliance book and the compliance 101 training book. And also there were at lunchtime some extra compliance 101 and advanced compliance books on the registration table outside. Please, if you have anybody that couldn't make it, grab an extra printed copy. Or if you had somebody that did join us virtually that wants a printed copy, they are first come, first serve on the table out there. If they go back to the office, they're just going in the trash can. So please take them. But also on our website, you've got the books, you've got the key assistance book, you've got the supportive housing training that's on there, and you have our presentation on the RCRS overview that kind of gives you a very brief how-to on a lot of the parts of RCRS. And then we have our YouTube videos. We've talked about our fair housing trainings. You can register for fair housing. It is free. But again, you need to go to the community living tab in order to register for those. Tax credit certifications accepted by NCHFA. Here is a list of those. And they're also noted in the QAP as well. And who does the HCCP, who does the C3P, and then the TACCS, which is done by Quadel. These are the three certifications that these are three of them. And then we've got the TCS and the SHCM. These are all of the tax credit certifications that we require somebody in a supervisory role to have. Addressing IRS noncompliance. Examples are households over income, the violation of the next available unit rule, the violation of the student rule, lack of proper utility allowance documentation, or physical inspection violations. The form issues reports corrected or uncorrected noncompliance to the IRS, and we report sales and dispositions of properties. Our state noncompliance items, these issues are important to us as an agency. So even though they might not be on the top of the IRS's brain, they are very important to us. And that is going to be failure to maintain the number of units at the required lower set-asides, failure to recertify annually for properties with agency loans, physical inspection noncompliance found outside of the Inspire guidelines. Program noncompliance, this is going to be your violations to the home rule or to the key program or to the National Housing Trust Fund program that are outside of the IRS. 8823s are not issued for state or program noncompliance. Last chance for questions. Any and all are welcome. Krista, are we good online? Except for you. You don't have any more questions. You're out for the day. If that is it, thank you guys so much for joining us. Don't forget to grab an extra book if you would like, and we will see you next year.